Question 1. Ms. Lee is a resident of North Carolina and is considering purchasing a long-term care insurance policy. She is concerned about the potential for premium increases in the future. Which of the following statements is most accurate regarding premium increases for long-term care insurance policies in North Carolina? A. Premiums for long-term care insurance policies in North Carolina are guaranteed to remain level throughout the life of the policy. B. North Carolina law prohibits insurance companies from ever increasing premiums for long-term care insurance policies. C. Premiums for long-term care insurance policies in North Carolina can be increased by the insurance company, but only with prior approval from the North Carolina Department of Insurance. D. Premiums for long-term care insurance policies in North Carolina can be increased by the insurance company, but the policy must clearly outline the conditions under which this can occur. The correct answer is D. Premiums for long-term care insurance policies in North Carolina can be increased by the insurance company, but the policy must clearly outline the conditions under which this can occur. North Carolina law does not guarantee that premiums for long-term care insurance policies will remain level. However, insurance companies are required to clearly outline the conditions under which premiums can be increased in the policy itself. This allows consumers to understand the potential for future cost increases before purchasing a policy. Question 2. Mr. Jones is a life insurance agent licensed in North Carolina. He is contacted by a potential client who lives in South Carolina. Can Mr. Jones sell life insurance to this client? A. Yes. Mr. Jones' North Carolina life insurance license allows him to sell life insurance to residents of any state. B. Yes, but only if Mr. Jones obtains a non-resident life insurance license for South Carolina. C. No. Mr. Jones' North Carolina life insurance license only allows him to sell life insurance to residents of North Carolina. D. No, but Mr. Jones can refer the client to a life insurance agent licensed in South Carolina. The correct answer is C. No. Mr. Jones' North Carolina life insurance license only allows him to sell life insurance to residents of North Carolina. Life insurance agents are typically required to be licensed in the state where the resident lives. Mr. Jones' North Carolina life insurance license only allows him to sell life insurance to residents of North Carolina. Question 3. An accident and health insurance policy issued in North Carolina includes a provision that excludes coverage for injuries sustained while participating in extreme sports. According to North Carolina regulations, how should extreme sports be defined within the policy? A. The policy should not define extreme sports at all, leaving it to the discretion of the insurer on a case-by-case basis. B. The policy can define extreme sports using a broad and generic definition, such as any activity with a high risk of injury. C. The policy definition of extreme sports must be specific and clear, providing examples of activities that would be excluded. D. The policy cannot exclude coverage for injuries sustained while participating in any legal activity. The correct answer is C. The policy definition of extreme sports must be specific and clear, providing examples of activities that would be excluded. North Carolina regulations require that exclusions within accident and health insurance policies be clear and unambiguous. When an exclusion applies to activities like extreme sports, the policy must provide a specific definition of the term and include examples of activities that would be considered extreme sports and excluded from coverage. This allows consumers to understand the scope of their coverage and avoid potential disputes with the insurer. Question 4. Ms. Garcia is a resident of North Carolina and is considering purchasing a Medicare supplement policy. She is aware of the standardized Medigap plans offered nationwide, A, B, C, D, etc. North Carolina also offers additional standardized Medigap plans. What is the most important thing for Ms. Garcia to consider when choosing between a standard Medigap plan, e.g., Plan C, and a North Carolina-specific Medigap plan? A. North Carolina-specific Medigap plans will always be more expensive than standard Medigap plans. B. Standard Medigap plans, A, B, C, D, etc., will offer the same benefits regardless of the state. C. North Carolina-specific Medigap plans may offer different benefits and coverage compared to standard Medigap plans. D. Ms. Garcia should choose the plan with the lowest monthly premium, regardless of the benefits offered. The correct answer is C. North Carolina-specific Medigap plans may offer different benefits and coverage compared to standard Medigap plans. While standard Medigap plans, A, B, C, D, etc., offer a set of standardized benefits nationwide, North Carolina may offer additional standardized plans with different benefits and coverage options. It's crucial for Ms. Garcia to compare the benefits offered by both standard and North Carolina-specific Medigap plans to determine which one best meets her specific needs and budget. Question 5. Mr. Khan is a North Carolina resident applying for a health insurance policy. He has a pre-existing medical condition. North Carolina follows what guaranteed issue rights for health insurance applicants with pre-existing conditions? A. Mr. Khan cannot be denied coverage due to a pre-existing condition, but the insurance company can charge him a higher premium. B. Mr. Khan is guaranteed coverage, but the insurance company can deny coverage for any treatment related to his pre-existing condition. C. Mr. Khan cannot be denied coverage or charged a higher premium due to a pre-existing condition, but there may be waiting periods before coverage applies. D. North Carolina does not have any guaranteed issue rights for health insurance applicants with pre-existing conditions. The correct answer is A. Mr. Khan cannot be denied coverage due to a pre-existing condition, but the insurance company can charge him a higher premium. North Carolina follows guaranteed issue rights for health insurance. This means that Mr. Khan cannot be denied coverage due to a pre-existing condition. However, the insurance company can charge him a higher premium based on his health status, but the rating factors used must be filed with and approved by the North Carolina Department of Insurance. Question 6. An individual health insurance policy issued in North Carolina includes a mandatory mental health parity provision. What does this provision require? A. The policy must cover all mental health conditions equally with no limitations or exclusions. B. The policy's benefits for mental health conditions must be equal to the benefits offered for physical health conditions. C. The policy must offer some level of mental health coverage, but the specific benefits can differ from physical health coverage. D. The provision does not apply to individual health insurance policies in North Carolina. The correct answer is B. The policy's benefits for mental health conditions must be equal to the benefits offered for physical health conditions. Mental health parity provisions require that the annual and lifetime dollar limits for mental health benefits be no more restrictive than the limits for medical, surgical benefits. In simpler terms, the policy cannot place a lower cap on how much the insurance company will pay for mental health treatment compared to physical health treatment. Question 7. A health insurance policy issued in North Carolina includes a rescission clause. What is the legal impact of this clause? A. The clause allows the insurer to cancel the policy at any time for any reason. B. The clause allows the policyholder to cancel the policy at any time for any reason, with a full premium refund. C. The clause allows the insurer to rescind the policy, cancel it retroactively, if there was material misrepresentation on the application. D. The clause requires the policyholder to undergo a medical exam every year to maintain coverage. The correct answer is C. The clause allows the insurer to rescind the policy, cancel it retroactively, if there was material misrepresentation on the application. Rescission clauses allow the insurance company to cancel a policy retroactively, typically within a contestable period, often 1 to 2 years from the policy issue date, if they discover the policyholder made a material misrepresentation on the application. A material misrepresentation is a false or misleading statement that could have affected the insurer's decision to issue the policy or the premium charged. Question 8. An agent is marketing Medicare Advantage (MA) plans in North Carolina. Which of the following statements is true regarding marketing practices for MA plans? A. Agents can only solicit enrollment for MA plans during the annual Medicare Open Enrollment Period, OEP. B. Agents can contact beneficiaries throughout the year to discuss and recommend MA plan options. C. Agents are prohibited from receiving any compensation based on the number of beneficiaries they enroll in MA plans. D. Agents can recommend specific MA plans without considering the individual needs of the beneficiary. The correct answer is B. Agents can contact beneficiaries throughout the year to discuss and recommend MA plan options. While there is a specific enrollment window for new beneficiaries, initial enrollment period following enrollment in Part A and B, agents can generally contact beneficiaries throughout the year to discuss and recommend MA plan options outside of the Open Enrollment Period, OEP. However, agents must follow specific marketing guidelines set by the Centers for Medicare and Medicaid Services, CMS, to ensure beneficiaries are presented with a fair and balanced comparison of available plans. Question 9. A group health insurance policy issued in North Carolina covers 20 employees. According to North Carolina law, which of the following statements is true regarding continuation coverage, COBRA, for terminated employees? A. COBRA continuation is not mandatory for group health plans with fewer than 20 employees. B. Terminated employees are entitled to COBRA continuation regardless of the reason for termination. C. The employer can set the premium rate for COBRA continuation. D. COBRA continuation can extend for a lifetime for qualified individuals. The correct answer is B. Terminated employees are entitled to COBRA continuation regardless of the reason for termination. North Carolina follows federal COBRA continuation provisions. COBRA applies to group health plans with 20 or more employees on at least one day in the prior year. Qualified beneficiaries, terminated employees, their spouses, and dependent children are generally entitled to COBRA continuation regardless of the reason for termination, with the exception of gross misconduct. The premium for COBRA continuation can be higher than the premium paid by active employees, but the employer cannot set an unreasonable rate. The continuation period typically lasts for 18 or 36 months depending on the qualifying event. Question 10. An individual life insurance policy issued in North Carolina includes a grace period for premium payments. What is the typical duration of a grace period in North Carolina? A. The grace period is always 30 days from the due date of the premium payment. B. North Carolina law does not mandate a specific grace period for life insurance policies. C. The grace period can vary depending on the insurance company, but it must be clearly stated in the policy. D. The grace period is typically tied to the policy loan value, with longer grace periods for policies with higher loan values. The correct answer is C. The grace period can vary depending on the insurance company, but it must be clearly stated in the policy. North Carolina does not mandate a specific grace period for life insurance policies. However, the grace period must be clearly stated in the policy itself and can vary depending on the insurance company. Common grace periods range from 10 to 31 days from the due date of the premium payment. Question 11. A health insurance policy issued in North Carolina covers alternative treatments, such as acupuncture. The policy requires pre-certification for these services. What does pre-certification typically involve? A. The policyholder simply needs to inform the insurance company in advance of seeking alternative treatments. B. The healthcare provider submits a detailed plan for the alternative treatment to the insurance company for approval before services are rendered. C. The policyholder pays for the alternative treatment upfront and then submits a claim for reimbursement to the insurance company. D. The insurance company provides a list of approved alternative treatment providers that the policyholder must use. The correct answer is B. The healthcare provider submits a detailed plan for the alternative treatment to the insurance company for approval before services are rendered. Pre-certification is a process where the healthcare provider submits a detailed plan for the alternative treatment to the insurance company for review and approval before services are rendered. This allows the insurer to determine if the proposed treatment is medically necessary and covered under the policy benefits. Question 12. An agent is explaining disability income insurance to a potential client in North Carolina. The client asks about the difference between own occupation and any occupation disability benefits. How should the agent respond? A. Own occupation benefits are paid regardless of the client's ability to work in any occupation, while any occupation benefits only pay if the client cannot work in their specific occupation. B. Own occupation benefits are paid if the client's disability prevents them from working in their current occupation, while any occupation benefits are only paid if the client cannot work in any occupation for which they are qualified. C. There is no difference. Both terms refer to the same type of disability benefit. D. Own occupation benefits are more expensive than any occupation benefits. The correct answer is B. Own occupation benefits are paid if the client's disability prevents them from working in their current occupation, while any occupation benefits are only paid if the client cannot work in any occupation for which they are qualified. Own occupation disability benefits are typically more expensive but provide more comprehensive coverage. They pay benefits if the client's disability prevents them from working in their current occupation, even if they could potentially work in a different occupation. Any occupation benefits, on the other hand, only pay if the client's disability prevents them from working in any occupation for which they are qualified, regardless of their previous occupation. Question 13. An individual health insurance policy issued in North Carolina excludes coverage for services provided by out-of-network providers. The policyholder experiences a medical emergency while traveling outside of North Carolina and receives care from a non-network provider. According to North Carolina regulations, what can the policyholder expect? A. The insurance company will cover the out-of-network services at the in-network benefit level. B. The insurance company will not provide any coverage for the out-of-network services. C. The insurance company may offer some reimbursement for the out-of-network services, but likely at a lower rate than in-network charges. D. The policyholder is responsible for paying the entire cost of the out-of-network services upfront and cannot file a claim with the insurance company. The correct answer is C. The insurance company may offer some reimbursement for the out-of-network services, but likely at a lower rate than in-network charges. While the policy excludes coverage for out-of-network providers, North Carolina regulations may allow for some reimbursement for emergency services received outside the network. The specific reimbursement amount will vary depending on the insurance company's policy and the usual and customary charges for similar services in the emergency location. It's important to note that out-of-pocket costs for out-of-network emergency services are likely to be higher than for in-network providers. Question 14. A life insurance agent is contacted by a potential client who wants to purchase a universal life insurance policy. The client is interested in the flexibility of universal life but is concerned about potential premium increases in the future. How should the agent respond? A. Premiums for universal life insurance policies are guaranteed to remain level throughout the life of the policy. B. The agent can guarantee the premium rate for the universal life policy. C. The agent should explain that premium payments in universal life policies can be adjusted to reflect the policyholder's needs and budget, but this may affect the death benefit or cash value accumulation. D. Universal life insurance policies are not suitable for clients who are concerned about premium increases. The correct answer is C. The agent should explain that premium payments in universal life policies can be adjusted to reflect the policyholder's needs and budget, but this may affect the death benefit or cash value accumulation. Universal life insurance policies offer flexibility in premium payments. Policyholders can typically adjust their premium payments within certain limits. However, lower premium payments will result in slower cash value accumulation or potentially a reduced death benefit if the policy falls short on premium payments. The agent should explain this trade-off to the client and emphasize the importance of understanding the impact of premium adjustments on the overall policy value. Question 15. A health insurance policy issued in North Carolina includes a coordination of benefits (COB) provision. What is the primary purpose of a COB provision? A. To ensure that a policyholder does not receive duplicate benefits for the same covered service from multiple health insurance plans. B. To establish the order in which benefits are paid by multiple health insurance plans when a policyholder is covered under more than one plan. C. To limit the total amount a policyholder can collect from all health insurance plans combined for a covered service. D. To prevent a policyholder from having more than one health insurance policy at the same time. The correct answer is B. To establish the order in which benefits are paid by multiple health insurance plans when a policyholder is covered under more than one plan. Coordination of benefits (COB) provisions are designed to prevent overpayment for covered services when a policyholder has coverage under more than one health insurance plan. The COB provision establishes the order in which benefits are paid by the primary and secondary plans to avoid exceeding the allowed benefit amount for a covered service. This helps to ensure efficient use of healthcare resources and avoids duplicate payments. Question 16. An accident and health insurance policy issued in North Carolina includes a provision for exclusions based on age. North Carolina regulations limit the use of age-related exclusions in these policies. What is an example of an age-related exclusion that would likely be considered a violation in North Carolina? A. Exclusion of coverage for maternity benefits for individuals over age 50. B. Exclusion of coverage for routine physical examinations for children under age 5. C. Exclusion of coverage for certain high-risk activities for individuals over age 65. D. Exclusion of coverage for vision care benefits for individuals under age 18. The correct answer is A. Exclusion of coverage for maternity benefits for individuals over age 50. North Carolina regulations generally prohibit age-related exclusions that limit coverage for essential health benefits for adults. Maternity benefits are typically considered an essential health benefit. Excluding coverage for maternity benefits solely based on age would likely be considered a violation. Question 17. A group health insurance policy issued in North Carolina is experience rated. What does this mean for the premium rate of the policy? A. The premium rate is the same for all policyholders in the group, regardless of their age or health status. B. The premium rate is based on the claims history and experience of the entire group of insured individuals. C. The premium rate is determined by the insurance company based on various factors, including the industry of the employer group. D. The premium rate is a fixed amount for the entire policy term and cannot be adjusted. The correct answer is B. The premium rate is based on the claims history and experience of the entire group of insured individuals. Experience-rated group health insurance policies base the premium rate on the claims history and experience of the entire group of insured individuals. Groups with higher healthcare utilization costs will typically pay higher premiums compared to groups with lower claims experience. Question 18. A life insurance agent is explaining the concept of contestability to a potential client in North Carolina. What is the typical contestability period for a life insurance policy in North Carolina? A. The policy is contestable for the entire lifetime of the insured. B. North Carolina does not have a specific contestability period for life insurance policies. C. The contestability period is typically 1 year from the policy issue date. D. The contestability period is typically 2 years from the policy issue date. The correct answer is D. The contestability period is typically 2 years from the policy issue date. The contestability period in North Carolina is typically 2 years from the policy issue date. During this period, the insurance company can contest the policy, potentially deny coverage or benefits, if they discover a material misrepresentation on the application. After the contestability period expires, the insurer's ability to contest the policy becomes more limited. Question 19. A health insurance policy issued in North Carolina covers prescription drugs. The policy includes a formulary, which is a list of preferred medications. What does it typically mean for a medication to be on the formulary? A. The medication is no longer effective and should not be used. B. The insurance company will cover the medication at a lower copay compared to non-formulary medications. C. The medication is only available through specific pharmacies contracted with the insurance company. D. The medication requires prior authorization from the healthcare provider before being covered. The correct answer is B. The insurance company will cover the medication at a lower copay compared to non-formulary medications. A formulary is a list of preferred medications that the insurance company covers at a lower cost-sharing level, typically lower copay or coinsurance, compared to non-formulary medications. This encourages the use of medications deemed to be cost-effective and clinically appropriate. Question 20. An agent is marketing Medicare Supplement, Medigap, plans in North Carolina. A potential client asks about the difference between a Medigap plan and a Medicare Advantage, MA, plan. How should the agent respond? A. Medigap plans are offered by the federal government, while MA plans are offered by private insurance companies. B. Medigap plans are a type of MA plan with additional benefits. C. Both Medigap and MA plans are supplemental insurance options for Medicare beneficiaries, but they differ in structure and coverage. D. Medigap plans replace traditional Medicare, while MA plans work alongside traditional Medicare. The correct answer is C. Both Medigap and MA plans are supplemental insurance options for Medicare beneficiaries, but they differ in structure and coverage. Both Medigap and MA plans are supplemental insurance options for Medicare beneficiaries, but they differ in structure and coverage. Medigap plans are standardized plans offered by private insurance companies that help pay for out-of-pocket costs associated with traditional Medicare, Parts A and B. MA plans, on the other hand, are offered by private insurance companies as an alternative to traditional Medicare. They typically bundle Parts A and B coverage into a single plan and may offer additional benefits like vision or dental coverage. Question 21. A long-term care insurance policy issued in North Carolina includes a benefit for home health care services. The policy outlines limitations on the number of hours of home health care covered per day. North Carolina regulations require long-term care insurance policies to offer what minimum daily coverage for home health care services? A. North Carolina does not mandate any minimum daily coverage for home health care services in long-term care policies. B. Long-term care policies must offer at least 4 hours of home health care coverage per day. C. Long-term care policies must offer coverage that meets the individual policyholder's needs, regardless of daily hour limitations. D. The minimum daily coverage for home health care services can vary depending on the insurance company. The correct answer is D. The minimum daily coverage for home health care services can vary depending on the insurance company. North Carolina does not currently have a specific mandate for minimum daily coverage of home health care services in long-term care insurance policies. However, the policy benefits and limitations outlined in the contract must be clear and unambiguous. Question 22. An individual health insurance policy issued in North Carolina excludes coverage for services provided by Christian Science practitioners. North Carolina follows what regulations regarding such exclusions in health insurance policies? A. The policy can exclude coverage for any type of alternative or complementary medicine. B. North Carolina prohibits all exclusions for services provided by licensed healthcare professionals. C. The exclusion is allowed as long as there is an option to purchase a rider that adds coverage for Christian Science practitioners. D. The insurance company must offer an equivalent level of benefits for services provided by other licensed healthcare professionals treating similar conditions. The correct answer is D. The insurance company must offer an equivalent level of benefits for services provided by other licensed healthcare professionals treating similar conditions. North Carolina restricts blanket exclusions for services provided by licensed healthcare professionals in health insurance policies. If a policy excludes coverage for a specific type of provider, like Christian Science practitioners in this case, the insurance company must offer an equivalent level of benefits for services provided by other licensed healthcare professionals who can treat similar conditions. This helps ensure that policyholders have access to a variety of treatment options. Question 23. A life insurance policy issued in North Carolina includes a disability income waiver of premium rider. What does this rider typically do? A. It waives the requirement to pay premiums if the policyholder reaches a specific age. B. It waives the requirement to pay premiums if the policyholder becomes disabled and is unable to work. C. It increases the death benefit payout if the policyholder dies from an accident. D. It allows the policyholder to pay premiums on a monthly basis instead of annually. The correct answer is B. It waives the requirement to pay premiums if the policyholder becomes disabled and is unable to work. A disability income waiver of premium rider is an optional add-on benefit to a life insurance policy. If the policyholder becomes disabled and meets the rider's definition of disability, the rider typically waives the requirement to pay further premiums, ensuring the life insurance policy remains active. Question 24. An agent is explaining critical illness insurance to a potential client in North Carolina. The client asks about the benefits payout for a covered critical illness. How does critical illness insurance typically pay out benefits? A. The insurance company pays out a lump sum benefit upon diagnosis of a covered critical illness. B. The insurance company makes monthly payments to the policyholder for a set period after diagnosis. C. The benefit is paid directly to the healthcare provider to cover medical expenses. D. The payout amount varies depending on the severity of the illness. The correct answer is A. The insurance company pays out a lump sum benefit upon diagnosis of a covered critical illness. Critical illness insurance typically pays out a lump sum benefit to the policyholder upon diagnosis of a covered critical illness, such as cancer or heart attack. This benefit can be used for various purposes, such as covering medical expenses, lost income, or other financial needs arising from the illness. Question 25. A health insurance policy issued in North Carolina covers mental health services. The policy requires outpatient mental health services to be pre-authorized before coverage applies. What does pre-authorization typically involve? A. The policyholder simply informs the insurance company in advance of seeking outpatient mental health services. B. The healthcare provider submits a review form outlining the diagnosis and treatment plan for approval before services are rendered. C. The policyholder pays for the outpatient mental health services upfront and then submits a claim for reimbursement to the insurance company. D. The insurance company provides a list of approved outpatient mental health providers that the policyholder must use. The correct answer is B. The healthcare provider submits a review form outlining the diagnosis and treatment plan for approval before services are rendered. Pre-authorization is a process where the healthcare provider submits a review form outlining the diagnosis and proposed treatment plan for outpatient mental health services to the insurance company for approval before services are rendered. This allows the insurer to assess the medical necessity of the treatment and ensure it aligns with the policy benefits. Question 26. A group health insurance policy issued in North Carolina is guaranteed issue. What does this mean for eligibility of new employees to enroll in the plan? A. The employer can deny coverage to new employees with pre-existing conditions. B. All new employees are automatically enrolled in the group health plan. C. New employees can choose to enroll in the plan during a specific enrollment window, regardless of their health status. D. New employees can enroll in the plan, but they may be subject to a waiting period before coverage becomes effective for pre-existing conditions. The correct answer is C. New employees can choose to enroll in the plan during a specific enrollment window, regardless of their health status. A guaranteed issue group health plan means all eligible employees, including new hires, can choose to enroll in the plan during a specific enrollment window, regardless of their health status. The employer cannot deny coverage based on pre-existing conditions. Question 27. An agent is marketing Medicare Part D prescription drug coverage plans in North Carolina. A potential client asks about the donut hole coverage gap in Part D plans. What does the donut hole refer to in Medicare Part D? A. The period between initial enrollment and coverage start date in a Medicare Part D plan. B. The gap in coverage between Medicare Part A and Part B benefits. C. The period after the initial deductible has been met but before reaching the out-of-pocket maximum in a Medicare Part D plan. D. The network of pharmacies that participate in a Medicare Part D plan. The correct answer is C. The period after the initial deductible has been met but before reaching the out-of-pocket maximum in a Medicare Part D plan. The donut hole refers to the coverage gap in Medicare Part D plans. After exceeding the initial deductible, beneficiaries are responsible for a portion of the medication cost, coinsurance, until they reach the out-of-pocket maximum. This gap in coverage is often referred to as the donut hole. Once the out-of-pocket maximum is reached, catastrophic coverage kicks in, and the plan typically covers a higher percentage of the medication cost. Question 28. A life insurance policy issued in North Carolina includes a grace period for premium payments. The policyholder is facing financial hardship and misses a premium payment. According to North Carolina regulations, what is typically included in the grace period notice sent by the insurance company? A. The notice only informs the policyholder that the premium is past due and the date by which payment is required to avoid a lapse. B. The notice must include information about reinstatement options if the policy lapses due to non-payment during the grace period. C. The notice can offer a discount on the premium amount if paid within the grace period. D. The notice must be sent by certified mail to ensure the policyholder receives it. The correct answer is B. The notice must include information about reinstatement options if the policy lapses due to non-payment during the grace period. North Carolina regulations require grace period notices for overdue life insurance premiums to include information about reinstatement options available to the policyholder if the policy lapses due to non-payment during the grace period. This helps ensure the policyholder understands the consequences of non-payment and their options for keeping the coverage active. Question 29. An individual health insurance policy issued in North Carolina covers preventive care services. The policy requires a referral from a primary care physician, PCP, to see a specialist for certain preventive care services. What is the purpose of requiring a referral for preventive care? A. This requirement helps to control healthcare costs by ensuring appropriate utilization of specialist services. B. The insurance company uses referrals to track which specialists policyholders are seeing. C. Referrals are necessary to establish a diagnosis before preventive care services can be rendered. D. This is a way for the PCP to gatekeep access to specialists and limit unnecessary consultations. The correct answer is A. This requirement helps to control healthcare costs by ensuring appropriate utilization of specialist services. Some health insurance policies may require a referral from a PCP to see a specialist for certain preventive care services. This requirement is often used as a cost control measure. The PCP can help coordinate care, ensure appropriate utilization of specialist services, and potentially identify preventive care needs that can be addressed during a routine PCP visit. Question 30. A variable universal life insurance policy issued in North Carolina offers the policyholder investment choices for the cash value accumulation. The policyholder is concerned about potential investment risks associated with these choices. How should the agent respond? A. Variable universal life insurance policies offer guaranteed returns on the cash value accumulation. B. The agent should downplay the investment risks and emphasize the potential for higher returns. C. The agent has a fiduciary duty to recommend specific investment options for the policyholder. D. The agent should explain the investment risks involved and how they can impact the policy's cash value and death benefit. The correct answer is D. The agent should explain the investment risks involved and how they can impact the policy's cash value and death benefit. Variable universal life insurance policies offer investment choices for the cash value accumulation, but these choices carry investment risk. The agent has an ethical obligation to disclose the risks involved and explain how they can impact the policy's cash value and death benefit. The agent should also discuss risk tolerance and investment options that align with the policyholder's financial goals and risk appetite. Question 31. An agent is explaining long-term care insurance benefits to a potential client in North Carolina. The client asks about the difference between home health care and nursing home care. How should the agent respond? A. Home health care and nursing home care are the same type of service provided in different settings. B. Home health care provides custodial care for daily living activities, while nursing home care focuses on skilled medical care. C. Home health care is typically more expensive than nursing home care. D. Long-term care insurance only covers the cost of nursing home care. The correct answer is B. Home health care provides custodial care for daily living activities, while nursing home care focuses on skilled medical care. Home health care and nursing home care are distinct services with different purposes. Home health care typically provides assistance with daily living activities, bathing, dressing, etc., in the policyholder's home. Nursing home care, on the other hand, provides a higher level of care, often including skilled medical services and 24-hour supervision in a dedicated facility. Question 32. A health insurance policy issued in North Carolina excludes coverage for services provided by chiropractors. North Carolina allows for certain mandated benefits in health insurance policies. Does chiropractic care fall under a mandated benefit in North Carolina? A. Yes, chiropractic care is a mandated benefit that must be covered by all health insurance policies in North Carolina. B. No, chiropractic care is not currently a mandated benefit in North Carolina. C. Mandated benefits for chiropractic care depend on the specific policy type, individual versus group. D. The answer depends on whether the chiropractor is in-network or out-of-network with the insurance company. The correct answer is B. No, chiropractic care is not currently a mandated benefit in North Carolina. As of today, chiropractic care is not a mandated benefit in North Carolina. This means health insurance policies can exclude coverage for chiropractic services. However, some policies may offer chiropractic coverage as an optional benefit. Question 34. An agent is explaining disability income insurance to a potential client in North Carolina. The client asks how long they will receive benefits if they become disabled. What factors typically determine the benefit period for disability income insurance? A. The benefit period is always a fixed number of years, regardless of the policyholder's age or occupation. B. The benefit period is determined solely by the client's choice during the application process. C. The benefit period typically depends on factors such as the policyholder's occupation, age at disability, and the specific policy provisions. D. Disability income benefits only continue until the policyholder reaches retirement age. Question 35. A health insurance policy issued in North Carolina covers inpatient hospital services. The policy includes a copay for each day of hospitalization. How does a copay typically work in the context of health insurance? A. The copay is a fixed percentage of the total hospital bill. B. The copay is a flat dollar amount the policyholder pays for each covered service, regardless of the total bill. C. The insurance company pays the copay directly to the hospital on the policyholder's behalf. D. The copay amount is deducted from the policyholder's out-of-pocket maximum. The correct answer is B. The copay is a flat dollar amount the policyholder pays for each covered service, regardless of the total bill. A copay is a flat dollar amount the policyholder pays for each covered service, regardless of the total bill. It's a form of cost sharing that encourages policyholders to utilize covered services but also helps manage healthcare costs. The remaining balance after the copay is typically subject to coinsurance, percentage of the bill, and may reach the out-of-pocket maximum if applicable. Question 35. A life insurance agent is contacted by a potential client interested in purchasing a term life insurance policy. The client is concerned about the policy lapsing if they miss a premium payment. What can the agent explain about grace periods for term life insurance policies in North Carolina? A. Term life insurance policies in North Carolina do not have a grace period for premium payments. B. The grace period for term life policies is always 30 days from the due date of the premium payment. C. The agent can guarantee the policy will not lapse as long as they are notified in advance of a missed payment. D. Term life insurance policies in North Carolina typically have a grace period during which the policy remains active even if a premium payment is missed. The correct answer is D. Term life insurance policies in North Carolina typically have a grace period during which the policy remains active even if a premium payment is missed. Term life insurance policies in North Carolina typically have a grace period, usually 10 to 31 days from the due date of the premium payment. During this grace period, the policy remains active even if a premium payment is missed. The insurance company is required to send a grace period notice informing the policyholder about the overdue payment and potential consequences of non-payment if the premium is not received by the end of the grace period. Question 36. A health insurance policy issued in North Carolina covers mental health services. The policy excludes coverage for experimental or investigational mental health treatments. What is the rationale behind excluding experimental treatments in health insurance policies? A. These treatments are not yet proven to be effective and may carry unknown risks. B. The insurance company wants to avoid covering services with high costs and uncertain outcomes. C. Experimental treatments are typically only available in research settings and not through standard healthcare providers. D. Federal regulations mandate that health insurance plans exclude coverage for experimental treatments. The correct answer is A. These treatments are not yet proven to be effective and may carry unknown risks. Health insurance policies often exclude coverage for experimental or investigational treatments because these treatments are not yet proven to be safe and effective for the intended use. They may carry unknown risks and lack sufficient scientific evidence to justify coverage by health insurance plans. Question 38. An agent is marketing Medicare Advantage (MA) plans in North Carolina. A potential client asks if they can keep their existing Medicare Supplement (Medigap) plan if they enroll in an MA plan. Can a beneficiary have both an MA plan and a Medigap plan in North Carolina? A. Yes. Beneficiaries can have both an MA plan and a Medigap plan, but it may not be very beneficial. B. No. Enrolling in an MA plan automatically terminates any existing Medigap plan coverage. C. Beneficiaries can only have an MA plan or a Medigap plan, but not both at the same time. D. The ability to have both an MA plan and a Medigap plan depends on the specific plans chosen. The correct answer is C. beneficiaries can only have an MA plan or a Medigap plan, but not both at the same time. Beneficiaries typically cannot have both an MA plan and a Medigap plan at the same time in North Carolina. This is because MA plans are designed as an alternative to traditional Medicare, Parts A and B, and often include benefits similar to what some Medigap plans offer. Having both could result in duplicate coverage and potentially higher premiums. Question 39. A variable universal life insurance policy issued in North Carolina offers death benefit options. One option allows the policyholder to increase the death benefit over time. What is this type of death benefit option typically called? A. Level death benefit. B. Guaranteed death benefit. C. Increasing death benefit. D. Flexible death benefit. The correct answer is C. Increasing death benefit. An increasing death benefit option allows the policyholder to increase the death benefit amount over time through additional premium payments or by allocating cash value accumulation towards increasing the benefit. This can be beneficial for individuals who want their life insurance coverage to keep pace with inflation or other changing needs. Question 39. A group health insurance policy issued in North Carolina is contributory. What does this mean for premium payments? A. The employer pays the entire premium for all covered employees. B. The policyholder, employee, pays the entire premium for their own coverage and any dependents. C. The premium cost is shared between the employer and the employee. D. The premium amount is based on the employee's salary. The correct answer is C. The premium cost is shared between the employer and the employee. A contributory group health insurance policy means the premium cost is shared between the employer and the employee. The employer typically pays a portion of the premium, and the employee pays the remaining balance through payroll deductions or direct payments. Question 40. An individual health insurance policy issued in North Carolina has a deductible. The policyholder incurs a medical expense that falls within the deductible amount. How does the deductible typically work in health insurance? A. The insurance company pays the entire deductible amount after the claim is submitted. B. The policyholder is responsible for paying the entire deductible amount upfront before the insurance company starts sharing any costs. C. The deductible amount is automatically deducted from any covered benefit payments made by the insurance company. D. The deductible amount is only applied if the policyholder uses out-of-network providers. The correct answer is B. The policyholder is responsible for paying the entire deductible amount upfront before the insurance company starts sharing any costs. A deductible is a fixed dollar amount that the policyholder is responsible for paying out of pocket for covered medical expenses before the insurance company begins to share costs. The policyholder is responsible for paying the entire deductible amount upfront before the insurance company starts paying according to the coinsurance or copay provisions of the policy. Question 42. A life insurance agent is meeting with a client who is considering purchasing a long-term care insurance policy. The client asks about the possibility of canceling the policy in the future if they no longer need long-term care. Does North Carolina have any regulations regarding cancellation rights for long-term care insurance policies? A. Long-term care insurance policies cannot be canceled by the policyholder under any circumstances. B. North Carolina mandates guaranteed cancellation rights for long-term care insurance policies after a certain period. C. Cancellation rights are solely at the discretion of the insurance company and depend on the specific policy provisions. D. Long-term care insurance policies can be canceled at any time, but the policyholder may not receive any premium refunds. The correct answer is B. North Carolina mandates guaranteed cancellation rights for long-term care insurance policies after a certain period. North Carolina, along with many other states, mandates guaranteed cancellation rights for long-term care insurance policies. This allows policyholders to cancel the policy within a specific period, typically 30 days, from the date of purchase and receive a full premium refund. Additionally, some policies may offer non-forfeiture benefits that allow for cancellation after the initial period with some form of premium refund or paid-up benefits depending on the policy provisions. Question 42. A health insurance policy issued in North Carolina excludes coverage for services provided by naturopaths. A policyholder disagrees with this exclusion and wants to file a complaint. What is the appropriate entity to file a complaint with regarding health insurance coverage disputes in North Carolina? A. The insurance agent who sold the policy. B. The North Carolina Department of Motor Vehicles, DMV. C. The health insurance company that issued the policy. D. The Better Business Bureau, BBB. The correct answer is C. The health insurance company that issued the policy. The North Carolina Department of Insurance, NCDOI, is the appropriate entity to file a complaint regarding health insurance coverage disputes in North Carolina. They have a consumer protection division that handles complaints about insurance policies, including coverage denials and exclusions. Question 43. An individual health insurance policy issued in North Carolina covers durable medical equipment, DME. The policy requires prior authorization for DME rentals. What does prior authorization typically involve in the context of health insurance? A. The policyholder simply informs the healthcare provider in advance about the need for DME rental. B. The healthcare provider submits a review form outlining the medical necessity for DME rental to the insurance company for approval before providing the equipment. C. The insurance company provides a list of approved DME rental suppliers that the policyholder must use. D. Prior authorization allows the policyholder to rent DME for a longer period than what is typically covered by the insurance plan. The correct answer is B. The healthcare provider submits a review form outlining the medical necessity for DME rental to the insurance company for approval before providing the equipment. Prior authorization is a process where the healthcare provider submits a review form outlining the medical necessity for a service or treatment, including DME rental in this case, to the insurance company for approval before providing the service or equipment. This allows the insurer to assess if the DME rental meets the policy's criteria for coverage and helps control healthcare costs. Question 45. A Medicare Part D prescription drug plan offered in North Carolina has a formulary that excludes a medication the policyholder has been taking for a chronic condition. The policyholder wants to appeal this decision. How can a Medicare Part D beneficiary appeal a coverage decision made by their prescription drug plan? A. The beneficiary can contact their doctor and request a different medication. B. The appeal process must be initiated through the insurance agent who sold the plan. C. The beneficiary has the right to appeal the decision by following the procedures outlined in their plan materials. D. Medicare recipients cannot appeal coverage decisions made by Part D prescription drug plans. The correct answer is C. The beneficiary has the right to appeal the decision by following the procedures outlined in their plan materials. Medicare Part D beneficiaries have the right to appeal coverage decisions made by their prescription drug plan. The specific appeal process may vary slightly between plans, but beneficiaries typically have the right to initiate an appeal by following the procedures outlined in their plan materials. This may involve submitting a written request for review, potentially with supporting documentation from their doctor. Question 45. A life insurance policy issued in North Carolina includes an accidental death benefit rider. This rider pays an additional benefit if the death is caused by an accident. The policy defines an accident as a sudden, unforeseen, and unintentional event. The policyholder dies after suffering a heart attack while jogging. What is most likely the outcome regarding the accidental death benefit rider in this scenario? A. The accidental death benefit will be paid because the heart attack was sudden and unintentional. B. The accidental death benefit will not be paid because a heart attack is a natural cause of death. C. The insurance company will likely deny the claim, and the beneficiary may need to file an appeal. D. The payout depends on whether the policyholder had a pre-existing heart condition. The correct answer is C. The insurance company will likely deny the claim, and the beneficiary may need to file an appeal. While the heart attack itself may be sudden and unintentional, it's not necessarily considered an accident according to most life insurance policy definitions. These definitions typically exclude natural causes of death, including heart attacks. In this scenario, the insurance company will likely deny the accidental death benefit claim due to the cause of death. The beneficiary may have the right to appeal the decision based on the specific policy language and details surrounding the heart attack event. Question 46. An agent is explaining critical illness insurance to a potential client in North Carolina. The client asks if the payout from a critical illness policy can be used for any purpose. How does critical illness insurance typically work regarding the use of benefits? A. The benefit must be used to pay for medical expenses related to the covered critical illness. B. The insurance company will distribute the benefit directly to the healthcare providers. C. The policyholder has complete discretion on how to use the benefit payout. D. The benefit can only be used to pay off existing debts. The correct answer is C. The policyholder has complete discretion on how to use the benefit payout. Critical illness insurance typically pays out a lump sum benefit to the policyholder upon diagnosis of a covered critical illness. The policyholder has discretion on how to use the benefit payout. This flexibility can be helpful for covering various expenses arising from a critical illness, such as medical bills, lost income, or childcare costs. Question 47. A health insurance policy issued in North Carolina covers outpatient mental health services. The policy has a coinsurance requirement for outpatient mental health services. What does coinsurance typically mean in health insurance? A. A flat dollar amount the policyholder pays for each covered service. B. A percentage of the allowed amount that the policyholder pays after the deductible is met. C. The coinsurance amount is deducted from the out-of-pocket maximum each time a covered service is used. D. Coinsurance applies only to in-network providers and not out-of-network providers. The correct answer is B. A percentage of the allowed amount that the policyholder pays after the deductible is met. Coinsurance is a percentage of the allowed amount, the amount the insurance company agrees to pay for a covered service, that the policyholder is responsible for paying after the deductible has been met. For example, if a policy has a coinsurance requirement of 20%, the policyholder would be responsible for 20% of the allowed amount for a covered service after the deductible has been paid. Question 48. A group health insurance policy issued in North Carolina is experience rated. What does this mean for premium costs? A. Premiums are the same for all employee groups regardless of their claims history. B. Premiums are based on factors such as the health status and claims history of the employee group. C. Experience-rated plans typically have lower deductibles than community-rated plans. D. The employer pays the entire premium for all covered employees in an experience-rated plan. The correct answer is B. Premiums are based on factors such as the health status and claims history of the employee group. An experience-rated group health insurance plan bases its premiums on factors such as the health status and claims history of the specific employee group insured under the plan. Groups with lower healthcare utilization costs may qualify for lower premiums compared to groups with higher claims history. Question 50. An agent is meeting with a client who wants to purchase a universal life insurance policy. The client asks about the difference between guaranteed and non-guaranteed elements of a universal life policy. What are some examples of guaranteed and non-guaranteed elements in a universal life insurance policy? A. Guaranteed elements: face amount death benefit, non-guaranteed elements, premium payment amounts. B. Guaranteed elements: cash value accumulation interest rate, Non-guaranteed elements, future premium costs. C. Guaranteed elements, death benefit payout, non-guaranteed elements, dividends paid on the policy. D. Guaranteed elements, policy renewal, non-guaranteed elements, available investment options. The correct answer is C. Guaranteed elements, death benefit payout, non-guaranteed elements, dividends paid on the policy. Universal life insurance policies have both guaranteed and non-guaranteed elements. Some guaranteed elements include the face amount death benefit payout and the right to renew the policy as long as premiums are paid. Non-guaranteed elements can include the cash value accumulation interest rate, future premium costs, and dividends paid on the policy. The insurance company guarantees the death benefit and the policyholder's right to renew, but cannot guarantee interest rates, future premiums, or dividends, as these may fluctuate based on market conditions and the insurance company's financial performance. Question 51. A health insurance policy issued in North Carolina covers preventive care services. The policy requires members to designate a primary care physician, PCP. What is the purpose of designating a PCP in a health insurance plan? A. This requirement helps to ensure continuity of care for the policyholder. B. The PCP acts as a gatekeeper and needs to approve any referrals to specialists. C. The insurance company uses the designated PCP to verify the policyholder's health status. D. Plans with a PCP designation typically have higher premiums compared to plans without this requirement. The correct answer is A. This requirement helps to ensure continuity of care for the policyholder. Many health insurance plans require members to designate a primary care physician, PCP. The PCP acts as a central point of contact for the policyholder's healthcare needs and coordinates care. This can help to ensure continuity of care, as the PCP has a comprehensive view of the policyholder's medical history. The PCP may also provide referrals to specialists for specific conditions when needed. Question 51. A life insurance policy issued in North Carolina lapses due to non-payment of premium. The policy includes a grace period. After the grace period expires, what options might the policyholder still have to reinstate the lapsed policy? A. The policy cannot be reinstated after the grace period expires. B. Reinstatement is typically possible if the policyholder pays the missed premium and any applicable late fees. C. Reinstatement may require evidence of insurability, good health, to be approved by the insurance company. D. All of the above options, B and C, are possible depending on the specific policy provisions. The correct answer is D. All of the above options, B and C, are possible depending on the specific policy provisions. Even if a life insurance policy lapses due to non-payment of premium, the policyholder may still have options for reinstatement during a specified period after the grace period expires. This typically involves paying the missed premiums, any applicable late fees, and potentially interest. In some cases, the insurance company may require evidence of insurability, good health, through a medical questionnaire or health exam before approving reinstatement. The specific requirements and limitations for reinstatement will depend on the individual policy provisions. Question 52. An individual health insurance policy issued in North Carolina has an out-of-pocket maximum. What does the out-of-pocket maximum represent? A. The maximum amount the policyholder can contribute towards premiums each year. B. The most the insurance company will pay for covered services in a calendar year. C. The total dollar amount the policyholder is responsible for paying out of pocket for covered services before the insurance company starts paying benefits. D. The out-of-pocket maximum is reached after the deductible is met. The correct answer is C. The total dollar amount the policyholder is responsible for paying out of pocket for covered services before the insurance company starts paying benefits. The out-of-pocket maximum is the total dollar amount the policyholder is responsible for paying out of pocket for covered services in a calendar year after the deductible has been met. This includes copays, coinsurance, and certain non-covered charges. Once the policyholder reaches the out-of-pocket maximum, the insurance company typically pays for 100% of covered expenses for the remainder of the calendar year. Question 53. A variable universal life insurance policy issued in North Carolina offers different investment options for the cash value accumulation. The policyholder is concerned about the fees associated with these investment options. What are some examples of fees that may be associated with variable universal life insurance policies? A. Mortality expense charges, a cost of insurance based on the policyholder's age and death benefit. B. Administrative fees, covers expenses for policy administration and maintenance. C. Surrender charges, a fee assessed if the policy is surrendered, canceled, before a certain period. D. All of the above fees, A, B, and C, may be applicable to variable universal life insurance policies. The correct answer is D. All of the above fees, A, B, and C, may be applicable to variable universal life insurance policies. Variable universal life insurance policies may have various fees associated with them, including mortality expense charges, a cost of insurance based on the policyholder's age and death benefit amount. Administrative fees, covers expenses for policy administration and maintenance. Investment expense charges, fees associated with the underlying investment options chosen by the policyholder within the variable universal life policy. Surrender charges, a fee assessed if the policy is surrendered, canceled, before a certain period, typically in the early years of the policy. These charges gradually reduce over time. Understanding these fees is important for policyholders to make informed decisions about variable universal life insurance and how they can impact the overall growth and value of the cash value accumulation. Question 54. A Medicare supplement, Medigap, plan issued in North Carolina is standardized by the federal government. The policyholder wants to know if they can switch Medigap plans during the year. Can a beneficiary change Medigap plans under any circumstances during the year? A. No. Beneficiaries cannot switch Medigap plans during the year unless they lose creditable coverage. B. Beneficiaries can only switch Medigap plans during a specific enrollment window each year. C. Yes. Beneficiaries can switch Medigap plans at any time during the year, but they may face underwriting requirements. D. Switching Medigap plans mid-year is not advisable, but there are no restrictions from a regulatory standpoint. The correct answer is B. Beneficiaries can only switch Medigap plans during a specific enrollment window each year. Medicare beneficiaries can generally switch Medigap plans during a specific enrollment window each year, typically during the 6-month period following their first enrollment in Medicare Part B, usually at age 65. However, they may also qualify for a special enrollment period to change Medigap plans if they lose other creditable health coverage, e.g., employer-sponsored plan ends. Question 55. An agent is explaining disability income insurance to a young client. The client asks if there is a waiting period before they can start receiving benefits if they become disabled. Does disability income insurance typically have a waiting period before benefits start? A. Disability income insurance policies never have a waiting period. B. There is always a standard waiting period for all disability income insurance policies. C. The presence and duration of a waiting period can vary depending on the specific policy provisions. D. Waiting periods only apply if the disability is caused by an accident. The correct answer is C. The presence and duration of a waiting period can vary depending on the specific policy provisions. Disability income insurance policies often have a waiting period, sometimes called an elimination period, before benefits start to pay out if the policyholder becomes disabled. The presence and duration of this waiting period can vary depending on the specific policy provisions. Common waiting period options might be 30 days, 60 days, 90 days, or even longer. Choosing a longer waiting period typically results in a lower premium cost for the disability insurance. Question 56. A health insurance policy issued in North Carolina covers in-network hospitalization services. The policy also has a daily room and board charge for inpatient stays. What does this daily room and board charge typically represent? A. The coinsurance percentage the policyholder owes for each day of hospitalization. B. A flat dollar amount the policyholder is responsible for each day they occupy a hospital room. C. The daily cost of room and board charges that the insurance company pays on the policyholder's behalf. D. The room and board charge is deducted from the out-of-pocket maximum each day. The correct answer is B. A flat dollar amount the policyholder is responsible for each day they occupy a hospital room. A daily room and board charge in a health insurance policy refers to a flat dollar amount the policyholder is responsible for each day they occupy a hospital room as part of an inpatient stay. This is separate from any coinsurance or copay requirements that may apply to other covered hospital services. Question 57. A health insurance policy issued in North Carolina excludes coverage for cosmetic surgery. The policyholder wants to undergo a surgical procedure to improve their appearance. They believe the procedure is medically necessary because it would improve their breathing difficulties. To qualify for coverage under the policy, what should the policyholder do? A. The policyholder can argue that the procedure is cosmetic and request coverage anyway. B. Coverage will likely be denied unless the policyholder can convince the insurance company the surgery is medically necessary for a covered condition. C. The policyholder should file a formal complaint with the North Carolina Department of Insurance, NCDOI. D. Cosmetic surgery exclusions are standard in health insurance plans, and there is nothing the policyholder can do to obtain coverage. The correct answer is B. Coverage will likely be denied unless the policyholder can convince the insurance company the surgery is medically necessary for a covered condition. Health insurance policies typically exclude coverage for cosmetic surgery. However, if the policyholder can demonstrate a medical reason for the surgery, such as the breathing difficulties impacting their health, there might be a chance for coverage. They should consult with their doctor to document the medical necessity of the procedure and submit a formal appeal to the insurance company with supporting medical documentation. Question 58. An agent is meeting with a client interested in purchasing a long-term care insurance policy. The client asks about inflation protection riders. What does an inflation protection rider typically do for a long-term care insurance policy? A. It adds coverage for additional benefits or services not included in the base policy. B. An inflation protection rider automatically waives any premium payments if the policyholder is unable to pay. C. This rider increases the benefit amount over time to help offset the rising costs of long-term care services. D. Inflation protection riders decrease the daily benefit amount the longer the policy is in effect. The correct answer is C. This rider increases the benefit amount over time to help offset the rising costs of long-term care services. Long-term care costs tend to rise over time due to inflation. An inflation protection rider is an optional add-on benefit that increases the daily benefit amount periodically to help maintain the purchasing power of the benefit in the future. This can be crucial as long-term care can be expensive, and the benefit amount needs to keep pace with inflation to adequately cover future costs. Question 59. A group health insurance policy issued in North Carolina is insured through a health maintenance organization, HMO. How does an HMO model typically work for covered individuals? A. Policyholders have the freedom to choose any healthcare provider they wish. B. HMO plans require designation of a primary care physician, PCP, who coordinates care and provides referrals to in-network specialists when needed. C. HMO plans typically have lower premiums compared to indemnity plans but may have a more limited network of providers. D. All of the above statements, B and C, are true for HMO plans. The correct answer is D. All of the above statements, B and C, are true for HMO plans. Health Maintenance Organizations, HMOs, are a type of managed care plan that emphasizes preventive care and care coordination. Here's how HMOs typically work. Limited network. HMO plans have a network of contracted providers, doctors, hospitals, that policyholders must utilize for covered services to receive the full benefits of the plan. PCP designation. Policyholders typically designate a primary care physician, PCP, who acts as a gatekeeper and coordinates their care. The PCP provides referrals to in-network specialists for specific conditions when medically necessary. Lower premiums. Due to the network limitations and focus on preventive care, HMO plans generally have lower premiums compared to indemnity plans that offer more flexibility in choosing providers. Question 60. A life insurance policy issued in North Carolina is assigned a policy loan value. What does the policy loan value represent? A. The guaranteed cash value benefit the policyholder will receive upon reaching a certain age. B. The amount the policyholder has paid in premiums over the life of the policy. C. The loan amount available to the policyholder by borrowing against the cash value accumulation in the policy. D. The policy loan value is deducted from the death benefit payout if the policyholder takes out a loan. The correct answer is C. The loan amount available to the policyholder by borrowing against the cash value accumulation in the policy. Some life insurance policies, particularly whole life and universal life policies, accumulate cash value over time. The policy loan value represents the amount the policyholder can borrow against the cash value of their policy. This loan is typically subject to interest charges and needs to be repaid with interest. Question 61. A Medicare Part D prescription drug plan offered in North Carolina has a formulary that includes several medications for a particular chronic condition. The policyholder wants to know if they can choose the most expensive medication on the formulary. How does a formulary typically work in a Medicare Part D prescription drug plan? A. The formulary is a list of preferred medications covered by the plan at the lowest cost to the policyholder. B. Pharmacists can substitute a generic medication for a brand name medication on the formulary if it's available. C. The policyholder has the right to choose any medication on the formulary regardless of cost. D. Formulary medications are typically only covered if prior authorization is obtained from the plan. The correct answer is A. The formulary is a list of preferred medications covered by the plan at the lowest cost to the policyholder. A formulary is a list of medications covered by a Medicare Part D prescription drug plan. The plan typically classifies medications into tiers based on cost and effectiveness. Lower tiers may have lower copays or coinsurance for preferred medications on the formulary, while higher tiers may have higher cost-sharing requirements for the policyholder. Policyholders generally have some flexibility in choosing medications on the formulary, but selecting a more expensive medication may result in a higher copay or coinsurance responsibility. Pharmacists may also be able to substitute a generic medication for a brand name medication on the formulary if it's available and therapeutically equivalent. Question 62. A life insurance agent is meeting with a client who is considering purchasing a term life insurance policy. The client asks if the policy value increases over time. Term life insurance typically does not accumulate cash value. What is the primary benefit of term life insurance? A. Term life insurance offers lifetime coverage as long as premiums are paid. B. Term life insurance policies accumulate cash value over time that the policyholder can access. C. The guaranteed death benefit is paid to the beneficiary if the insured person dies during the specified term of the policy. D. Term life insurance premiums are typically level throughout the entire policy term. The correct answer is C. The guaranteed death benefit is paid to the beneficiary if the insured person dies during the specified term of the policy. Term life insurance is a temporary form of life insurance coverage lasting for a specific period, e.g., 10, 20, or 30 years. Unlike whole life or universal life insurance, term life policies typically do not accumulate cash value. The primary benefit of term life insurance is the guaranteed death benefit payout to the beneficiary if the insured person dies during the specified term of the policy. This benefit can help financially secure beneficiaries in the event of the policyholder's death. Question 63. An individual health insurance policy issued in North Carolina covers mental health services. The policy defines in-network mental health providers. What does an in-network provider typically mean in health insurance? A. In-network providers are specialists who require a referral from a primary care physician, PCP. B. Out-of-network providers are not covered under the health insurance plan. C. In-network providers have contracted with the insurance company to provide covered services at pre-negotiated rates. D. Using in-network providers typically results in higher out-of-pocket costs for the policyholder. The correct answer is C. In-network providers have contracted with the insurance company to provide covered services at pre-negotiated rates. In health insurance, an in-network provider refers to a healthcare professional, doctor, hospital, etc., who has a contract with the insurance company. These providers agree to provide covered services at pre-negotiated rates, which typically translates to lower out-of-pocket costs for the policyholder compared to using out-of-network providers. Question 64. A group health insurance policy issued in North Carolina is a high-deductible health plan, HDHP. HDHPs are often paired with health savings accounts, HSAs. What is a key advantage of using an HSA in conjunction with an HDHP? A. HSAs allow policyholders to use pre-tax dollars to contribute to the account for qualified medical expenses. B. HSA funds roll over unused amounts each year, allowing you to accumulate savings for future healthcare needs. C. HSAs can be used to pay for premiums for the HDHP they are paired with. D. All of the above, A, B, and C, are advantages of using an HSA with an HDHP. The correct answer is D. All of the above, A, B, and C, are advantages of using an HSA with an HDHP. High-deductible health plans, HDHPs, typically have lower premiums but higher deductibles compared to traditional health insurance plans. Health savings accounts, HSAs, are tax-advantaged accounts that can be paired with qualified HDHPs. Here are some key advantages of using an HSA with an HDHP. Tax-advantaged contributions. Policyholders can contribute pre-tax dollars to their HSA, reducing their taxable income. Rollover of unused funds. Unlike funds in a flexible spending account, FSA, unused amounts in an HSA roll over each year, allowing you to accumulate savings for future healthcare needs. Use for qualified medical expenses. HSA funds can be used to pay for a wide range of qualified medical expenses, including deductibles, copays, coinsurance, and even some over-the-counter medications. Payment for HDHP premiums. In some cases, HSA funds can be used to pay the monthly premiums for the HDHP they are paired with. However, this is only allowed for qualified medical expenses after you reach a certain age, typically 65. Question 65. A health insurance policy issued in North Carolina covers durable medical equipment, DME. The policyholder inquires about obtaining a new wheelchair. What does durable medical equipment, DME, typically refer to in health insurance? A. Disposable medical supplies, such as bandages or syringes, are considered DME. B. DME includes wheelchairs, walkers, and other medical equipment used in the home for an extended period. C. The policy may require pre-authorization from the insurance company before covering DME. D. All of the above statements, B and C, are true regarding DME coverage in health insurance. The correct answer is D. All of the above statements, B and C, are true regarding DME coverage in health insurance. Durable medical equipment, DME, refers to medical equipment that is expected to last for at least 3 years and is used in the home for an extended period. Common examples of DME include wheelchairs, walkers, hospital beds, nebulizers, and blood sugar monitors. Health insurance policies may have specific coverage guidelines for DME, including prior authorization requirements from the insurance company before coverage is approved. Question 66. An agent is explaining critical illness insurance to a client. The client asks if there is a waiting period before they can receive benefits if they are diagnosed with a covered critical illness. Does critical illness insurance typically have a waiting period before benefits are paid? A. Critical illness insurance policies never have a waiting period. B. All critical illness policies have a standard waiting period before benefits are paid. C. The presence and duration of a waiting period can vary depending on the specific policy provisions. D. Waiting periods only apply if the critical illness is caused by a specific condition. The correct answer is C. The presence and duration of a waiting period can vary depending on the specific policy provisions. Similar to disability income insurance, critical illness insurance policies may have a waiting period, sometimes called a survival period, before benefits are paid out if the policyholder is diagnosed with a covered critical illness. The presence and duration of this waiting period can vary depending on the specific policy provisions. Common waiting period options might be 14 days, 30 days, or even longer. Question 67. A life insurance policy issued in North Carolina offers accelerated death benefits, ADB, as an optional rider. What does an ADB rider typically allow the policyholder to do? A. Withdraw a portion of the policy's cash value without surrendering the policy. B. ADB allows the policyholder to receive a portion of the death benefit early if they are diagnosed with a terminal illness. C. The ADB benefit is paid directly to the beneficiary upon the policyholder's death. D. All life insurance policies automatically include an ADB rider. The correct answer is B. ADB allows the policyholder to receive a portion of the death benefit early if they are diagnosed with a terminal illness. Accelerated death benefits, ADB, is an optional rider that can be attached to some life insurance policies. An ADB rider allows the policyholder to receive a portion of the death benefit early if they are diagnosed with a terminal illness that is expected to lead to death within a certain timeframe, typically 2 years or less. This benefit can be used for various purposes, such as covering medical expenses, long-term care costs, or debt settlement. It's important to note that using the ADB rider will reduce the death benefit payout to the beneficiary upon the policyholder's eventual death. Question 68. A group short-term health insurance policy issued in North Carolina is designed to provide temporary medical coverage. What are some limitations typically associated with short-term health insurance plans? A. Short-term health plans may not cover pre-existing conditions. B. Short-term health insurance policies typically have annual coverage renewal limitations. C. Benefits under short-term health plans may have exclusions or limitations compared to comprehensive health insurance. D. All of the above limitations, A, B, and C, are typical of short-term health insurance plans. The correct answer is D. All of the above limitations, A, B, and C, are typical of short-term health insurance plans. Short-term health insurance plans are temporary health insurance policies designed to provide limited medical coverage for a short period, typically lasting for a few months up to 1 year. They are not a substitute for comprehensive health insurance and generally come with several limitations. Pre-existing condition exclusions. Short-term health plans may not cover pre-existing conditions, which can be a significant drawback for people with ongoing health issues. Renewal limitations. Unlike comprehensive health plans, short-term health insurance policies may have limitations on how many times they can be renewed. Limited benefits. Benefits under short-term health plans may have exclusions or limitations compared to comprehensive health insurance plans. This could involve coverage caps on annual or lifetime benefits, limitations on specific types of care, or higher deductibles and copays. Question 69. A life insurance policy issued in North Carolina has a contestability period. What does the contestability period typically represent in a life insurance policy? A. The period during which the insurance company can contest the validity of the policy after the policyholder's death. B. The time frame for the policyholder to pay the initial premium after the policy is issued. C. The guaranteed death benefit amount cannot be changed by the insurance company after the contestability period. D. The contestability period allows the policyholder to cancel the policy and receive a full refund of premiums paid. The correct answer is A. The period during which the insurance company can contest the validity of the policy after the policyholder's death. The contestability period is a clause in most life insurance policies that allows the insurance company to contest the validity of the policy after the policyholder's death. This period typically lasts for 2 years from the policy issue date. During this time, the insurance company can investigate the application for misrepresentations or omissions of material facts that could affect their decision to issue coverage. If the insurance company discovers material misrepresentations on the application, they may be able to void the policy and deny the death benefit payout. Question 70. A health insurance policy issued in North Carolina covers preventive care services. The policyholder inquires about the process for obtaining a referral to see a specialist. Does a referral requirement for specialists typically apply to all health insurance plans? A. All health insurance plans require referrals to see specialists. B. Referral requirements typically only apply to HMO plans, not PPO plans. C. Referrals may not be required if the specialist is part of the insurance company's network. D. Whether a referral is needed depends on the specific plan design and network provisions. The correct answer is D. Whether a referral is needed depends on the specific plan design and network provisions. Whether a referral is required to see a specialist depends on the specific health insurance plan design and network provisions. HMO plans. Health Maintenance Organization, HMO, plans typically require a referral from a primary care physician, PCP, to see a specialist within the HMO network. This approach helps to coordinate care and manage costs. PPO plans. Preferred Provider Organization, PPO, plans offer more flexibility in choosing providers. While referrals may not always be required, using an in-network specialist without a referral might result in higher out-of-pocket costs for the policyholder. Other plan designs. Some indemnity plans or high-deductible health plans, HDHPs, may not require referrals, but out-of-pocket costs may be higher for going directly to a specialist without a referral. It's always best to consult the specific plan details or contact the insurance company to confirm if a referral is needed for a specialist visit. Question 71. A Medicare Supplement, Medigap, plan issued in North Carolina is designed to help beneficiaries with out-of-pocket costs associated with Original Medicare, Parts A and B. The policyholder wants to know if a Medigap plan can cover the cost of prescription drugs. A. Medigap plans typically do not cover prescription drug costs. Separate Medicare Part D coverage is needed for prescription drug benefits. B. All Medigap plans are required to cover prescription drug costs. C. Some Medigap plans may offer limited prescription drug coverage, but it's not standard. D. Medigap plans can be used to pay the deductible for a Medicare Part D prescription drug plan. The correct answer is A. Medigap plans typically do not cover prescription drug costs. Separate Medicare Part D coverage is needed for prescription drug benefits. Medicare Supplement, Medigap, plans are designed to help beneficiaries with out-of-pocket costs associated with original Medicare, Parts A and B. This can include deductibles, copays, and coinsurance for covered hospitalizations, doctor visits, and other Medicare-approved services. However, Medigap plans typically do not cover prescription drug costs. Beneficiaries will need separate Medicare Part D coverage to get prescription drug benefits. Question 72. An agent is explaining long-term care insurance to a client. The client asks about the possibility of premium increases in the future. Can long-term care insurance premiums increase after the policy is issued? A. Long-term care insurance premiums are guaranteed to remain level throughout the entire policy. B. Premiums for long-term care insurance can increase if the insurance company experiences higher than anticipated claims costs. C. Most long-term care insurance policies offer guaranteed renewability, but premiums can still be adjusted. D. All of the above statements, B and C, are true regarding premiums for long-term care insurance. The correct answer is D. All of the above statements, B and C, are true regarding premiums for long-term care insurance. Unlike some life insurance policies with guaranteed level premiums, long-term care insurance premiums can potentially increase after the policy is issued. Here's why. Claims experience. If an insurance company experiences higher than anticipated claims costs, they may need to raise premiums to maintain the financial stability of the long-term care insurance product. Guaranteed renewability. Most long-term care insurance policies are guaranteed renewable, meaning the insurance company cannot cancel the policy as long as premiums are paid. However, this guarantee doesn't extend to guaranteed level premiums. The insurance company may request approval for premium increases from state regulators. Question 73. A health insurance policy issued in North Carolina covers mental health services. The policy defines exclusions for certain treatments. What is the purpose of exclusions in a health insurance policy? A. Exclusions list services or conditions that are not covered under the health insurance plan. B. Exclusions typically outline the benefits and services covered by the health insurance plan. C. All healthcare services are covered under a health insurance plan, and there are no exclusions. D. Exclusions define the amount the policyholder will be responsible for paying out of pocket. The correct answer is A. Exclusions list services or conditions that are not covered under the health insurance plan. Exclusions in a health insurance policy outline services or conditions that are not covered under the plan. This helps to clarify what the policy covers and what the policyholder's financial responsibility might be for excluded services. It's important to carefully review the exclusions section of your health insurance policy to understand what services are not covered. Common exclusions may include cosmetic surgery, certain types of alternative therapies, or dental and vision care, unless offered as optional riders. Question 74. A life insurance policy issued in North Carolina offers a grace period for premium payments. What does a grace period typically allow for in a life insurance policy? A. The grace period extends the coverage period of the life insurance policy. B. The grace period is an additional time frame after the due date to pay a premium before the policy lapses. C. Any premium payments made during the grace period will accrue interest. D. The grace period allows the policyholder to change the beneficiary designation on the policy. The correct answer is B. The grace period is an additional time frame after the due date to pay a premium before the policy lapses. A grace period is a courtesy extended by the insurance company that allows for a short window of time after the due date to pay a premium before the policy lapses. The typical grace period for life insurance policies is 30 days, but it can vary depending on the specific policy provisions. During the grace period, the policy remains active, but coverage may be suspended if the premium is not paid by the end of the grace period. Question 77. An individual health insurance policy issued in North Carolina has a deductible. The policyholder asks for clarification on how the deductible applies. What does a deductible typically represent in a health insurance plan? A. The deductible is a fixed dollar amount the policyholder must pay for covered services each year before the insurance company starts sharing costs. B. Once the deductible is met, the policyholder is responsible for a copayment for covered services. C. The deductible amount applies to all covered services throughout the policy year. D. All of the above statements, A, B, and C, are true regarding deductibles in health insurance. The correct answer is D. All of the above statements, A, B, and C, are true regarding deductibles in health insurance. A deductible is a fixed dollar amount that the policyholder must pay for covered medical expenses each year before the insurance company starts sharing costs. Once the deductible is met, the insurance company typically begins to pay a share of covered expenses according to the coinsurance provision, usually a percentage, until the out-of-pocket maximum is reached. The deductible applies to all covered services throughout the policy year, not just specific conditions. Question 76. A life insurance agent is meeting with a young adult interested in purchasing life insurance. The young adult is unsure if they need life insurance at this point in their life. What are some factors to consider when deciding on the need for life insurance? A. Age and overall health are important factors to consider when determining the need for life insurance. B. Life insurance needs typically increase as individuals acquire dependents and financial responsibilities. C. Even without dependents, life insurance can help cover final expenses or outstanding debts. D. All of the above factors, A, B, and C, are important to consider when deciding on the need for life insurance. The correct answer is D. All of the above factors, A, B, and C, are important to consider when deciding on the need for life insurance. Several factors can influence the need for life insurance, and it's not just for people with dependents. Here are some key considerations. Age and health. Younger and healthier individuals typically qualify for lower premiums. Dependents. The presence of dependents, such as spouses or children, creates a financial need if the primary wage earner dies. Financial responsibilities. Outstanding debts, mortgages, student loans, or future financial needs can be reasons to consider life insurance. Final expenses. Life insurance can help cover funeral costs and other final expenses, relieving this burden from loved ones. Even young adults without dependents might consider a term life insurance policy with a low premium to start building a safety net and secure insurability for the future as their needs change. Question 78. A health insurance policy issued in North Carolina covers maternity services. The policyholder inquires about the process for pre-notification of pregnancy. Does a health insurance plan typically require notification of pregnancy? A. All health insurance plans require notification of pregnancy before coverage begins. B. Pre-notification of pregnancy is not required and typically has no impact on coverage for maternity services. C. Plans may offer discounts or incentives for prenatal care if the policyholder notifies them of pregnancy early. D. Notification is only required if the pregnancy is considered high risk. The correct answer is B. Pre-notification of pregnancy is not required and typically has no impact on coverage for maternity services. Pre-notification of pregnancy is generally not required under health insurance plans. However, there are a few things to consider. Coverage. Maternity services are typically covered benefits under health insurance plans. Pre-existing conditions. If the pregnancy is considered high risk due to pre-existing medical conditions, pre-notification might be helpful to ensure coverage and avoid any potential issues. Plan benefits. Some plans may offer benefits or discounts for prenatal care if the policyholder notifies them of pregnancy early. This is not a requirement but can be an advantage for early and preventive care. Question 78. An agent is explaining disability income insurance to a client. The client asks how long benefits will continue if they become disabled. What is the benefit period under a disability income insurance policy? A. The benefit period is the time frame during which the insurance company will investigate a disability claim. B. Disability income insurance benefits typically continue until the policyholder reaches a certain age, like 65. C. The benefit period defines how long the insurance company will pay benefits if the policyholder becomes disabled. D. All disability income insurance policies offer lifetime benefits for covered disabilities. The correct answer is C. The benefit period defines how long the insurance company will pay benefits if the policyholder becomes disabled. The benefit period in a disability income insurance policy defines the maximum length of time the insurance company will pay benefits if the policyholder becomes disabled and meets the policy definition of disability. Common benefit period options include 2 years, 5 years, or own occupation until age 65, meaning benefits continue as long as the policyholder cannot perform their specific occupation due to disability. Question 79. A group health insurance policy issued in North Carolina covers out-of-network emergency services. What does coverage for out-of-network emergency services typically entail in a health insurance plan? A. Out-of-network emergency services are never covered under a health insurance plan. B. Emergency services are covered regardless of the network affiliation if it's a true medical emergency. C. Coverage for out-of-network emergency services may come with higher out-of-pocket costs for the policyholder. D. All of the above statements, B and C, are true regarding out-of-network emergency services. The correct answer is D. All of the above statements, B and C, are true regarding out-of-network emergency services. Health insurance plans typically provide coverage for emergency services regardless of whether the provider is in-network or out-of-network. This is because emergency situations often require immediate medical attention, and going to the nearest emergency room might be necessary. However, there are some key points to consider. Emergency versus urgent care. The definition of an emergency is crucial. True emergencies involve life-threatening situations requiring immediate medical attention. Urgent care needs, while important, may not qualify for the same level of coverage for out-of-network providers. Higher out-of-pocket costs. While emergency services are generally covered, using an out-of-network provider might result in higher out-of-pocket costs for the policyholder. This could include higher deductibles, coinsurance, or balance billing, charges from the provider exceeding the amount allowed by the insurance company. It's always best to consult the plan details and contact the insurance company if you have any questions about coverage for emergency services. Question 80. A life insurance policy issued in North Carolina includes a disability waiver of premium rider. What does a disability waiver of premium rider typically do for a life insurance policy? A. The waiver rider waives future premium payments if the policyholder reaches a certain age. B. A disability waiver of premium rider waives premium payments if the policyholder becomes disabled and meets the policy definition of disability. C. The rider increases the face amount of the death benefit if the policyholder becomes disabled. D. All disability income insurance policies automatically include a disability waiver of premium rider. The correct answer is B. A disability waiver of premium rider waives premium payments if the policyholder becomes disabled and meets the policy definition of disability. A disability waiver of premium rider is an optional rider that can be attached to some life insurance policies. This rider waives the future premium payments for the life insurance policy if the policyholder becomes disabled and meets the policy definition of disability. This can be a valuable benefit, ensuring the life insurance policy remains active and the death benefit is still paid to the beneficiary even if the policyholder can't work and pay premiums due to disability. Question 81. An individual health insurance policy issued in North Carolina has a coinsurance provision. The policy defines the coinsurance percentage. What does coinsurance typically represent in a health insurance plan? A. Coinsurance is a fixed dollar amount the policyholder pays for covered services after the deductible is met. B. Once the deductible is met, the coinsurance clause outlines the percentage share of covered services the policyholder will be responsible for. C. Coinsurance applies only to in-network providers and not out-of-network providers. D. All of the above statements, A, B, and C, are true regarding coinsurance in health insurance. The correct answer is B. Once the deductible is met, the coinsurance clause outlines the percentage share of covered services the policyholder will be responsible for. Coinsurance is a provision in a health insurance plan that outlines the percentage share of covered services the policyholder will be responsible for after the deductible is met. For example, a common coinsurance provision might be 80/20. This means the insurance company will pay 80% of the allowed charges for covered services, and the policyholder will be responsible for the remaining 20%, coinsurance. Coinsurance typically applies to both in-network and out-of-network providers, but the coinsurance percentage might be higher for out-of-network providers. Question 84. A Medicare Part D prescription drug plan offered in North Carolina covers certain medications on a formulary. The policyholder inquires about the process for refilling a prescription. Can mail-order prescriptions typically be used to refill medications covered by a Medicare Part D plan? A. Mail-order prescriptions are not allowed under Medicare Part D prescription drug plans. B. Mail-order prescriptions can be an option for refilling covered medications on the formulary, and they may sometimes offer lower costs. C. All medications covered by Medicare Part D must be filled through mail-order pharmacies. D. Mail-order is only an option if the medication is not available at a local retail pharmacy. The correct answer is B. Mail-order prescriptions can be an option for refilling covered medications on the formulary, and they may sometimes offer lower costs. Medicare Part D prescription drug plans typically allow mail-order prescriptions as an option for refilling covered medications on the formulary. Mail-order pharmacies can sometimes offer lower costs compared to filling prescriptions at a local retail pharmacy. Here are some key points to consider. Convenience. Mail order can be a convenient way to refill prescriptions, especially for maintenance medications. Cost savings. Mail order prescriptions may offer lower copays or costs compared to filling at retail pharmacies. Formulary. Mail order fulfillment will still follow the plan's formulary, so not all medications may be available through mail order. It's always best to check with your specific Medicare Part D plan and preferred pharmacies to see if mail order is an option for your prescriptions and to compare potential cost savings. Question 83. A health insurance policy issued in North Carolina covers preventive care services. The policyholder inquires about annual wellness visits. Are annual wellness visits typically covered under preventive care benefits in a health insurance plan? A. Annual wellness visits are not covered under preventive care and may require a separate copay. B. Preventive care benefits typically cover annual wellness visits with no out-of-pocket costs for the policyholder. C. Coverage for annual wellness visits may vary depending on the specific plan design. D. All of the above statements, A, B, and C, are true regarding coverage for annual wellness visits. The correct answer is D. All of the above statements, A, B, and C, are true regarding coverage for annual wellness visits. Coverage for annual wellness visits can vary depending on the specific health insurance plan design. Here's what to consider. Preventive care benefits. Most health insurance plans cover preventive care services, including screenings and immunizations, to help prevent illness and promote early detection of potential health problems. Annual wellness visits may fall under this category. Plan details. Check the specific preventive care benefit section of your health insurance plan to see if annual wellness visits are covered and whether there are any associated out-of-pocket costs like copays. Affordable Care Act, ACA. The ACA requires most health insurance plans to cover preventive care services with no out-of-pocket costs for the policyholder. However, there may be exceptions depending on the plan type, e.g., grandfathered plans. It's always best to consult your plan details or contact your insurance company to confirm coverage for annual wellness visits and any potential out-of-pocket costs. Question 84. A life insurance agent is meeting with a client interested in a universal life insurance policy. The client asks about the flexibility of these policies. What is a key feature of universal life insurance that allows for flexibility? A. Universal life insurance policies offer a guaranteed death benefit throughout the entire policy term. B. Unlike term life insurance, universal life policies can accumulate cash value over time. C. The policyholder can adjust the premium payments within certain limits. D. All of the above statements, B and C, are true regarding flexibility in universal life insurance. The correct answer is D. All of the above statements, B and C, are true regarding flexibility in universal life insurance. Universal life insurance offers more flexibility compared to term life insurance. Here are some key features. Cash value accumulation. Unlike term life, universal life policies can accumulate cash value over time. A portion of the premium payment goes towards the death benefit, and the remaining amount accumulates cash value that can grow over time. Premium flexibility. Policyholders may have some flexibility in adjusting premium payments within certain limits. This can be helpful for managing changing budgets. Death benefit flexibility. In some cases, policyholders may be able to adjust the death benefit amount within certain limits. Question 87. A health insurance policy issued in North Carolina has a network of preferred providers, PPO. The policyholder wants to know the benefits of using in-network providers. What are some advantages of using in-network providers under a PPO health insurance plan? A. In-network providers typically offer lower copayments for covered services. B. Using in-network providers reduces the need for referrals from a primary care physician, PCP. C. In-network providers are required for coverage under a PPO health insurance plan. D. All of the above statements, A and B, are advantages of using in-network providers with a PPO plan. The correct answer is D. All of the above statements, A and B, are advantages of using in-network providers with a PPO plan. Preferred Provider Organization, PPO, plans offer more flexibility in choosing providers compared to HMO plans. However, using in-network providers within the PPO network typically offers advantages. Lower out-of-pocket costs. In-network providers agree to pre-negotiated rates with the insurance company. This often translates to lower deductibles, copays, and coinsurance for the policyholder compared to using out-of-network providers. Reduced need for referrals. While referrals may not always be required, PPO plans might have lower out-of-pocket costs if you see in-network specialists after getting a referral from your PCP. This can help streamline the care coordination process. While you have the flexibility to go out-of-network with a PPO plan, be prepared for potentially higher out-of-pocket costs. Question 86. A disability income insurance policy issued in North Carolina has an elimination period. What does the elimination period in a disability income insurance policy typically represent? A. The elimination period is the timeframe during which the insurance company will pay the death benefit to the beneficiary. B. It's the waiting period after the policyholder becomes disabled before benefits begin. C. The elimination period defines the maximum length of time the insurance company will pay benefits. D. All of the above statements, A, B, and C, are true regarding the elimination period in disability income insurance. The correct answer is B. It's the waiting period after the policyholder becomes disabled before benefits begin. The elimination period in a disability income insurance policy is the waiting period after the policyholder becomes disabled and meets the policy definition of disability before benefits begin. This period is typically 30, 60, 90 days, or even longer depending on the specific policy provisions. Benefits are not paid for covered disabilities until the elimination period is over. Question 87. An agent is explaining critical illness insurance to a client. The client asks if there is a waiting period before they can apply for this type of coverage. Are there typically any waiting periods for applying for critical illness insurance? A. Critical illness insurance typically has a waiting period before you can apply for coverage. B. There are no waiting periods to apply for critical illness insurance, but there might be a waiting period before benefits are paid. C. Pre-existing conditions can prevent someone from qualifying for critical illness insurance. D. All of the above statements, B and C, are true regarding critical illness insurance. The correct answer is D. All of the above statements, B and C, are true regarding critical illness insurance. There are typically no waiting periods to apply for critical illness insurance. However, two key points to consider. Waiting period for benefits. Similar to disability income insurance, critical illness insurance policies may have a waiting period before benefits are paid out after diagnosis of a covered critical illness. Pre-existing conditions. Pre-existing conditions can affect your eligibility or insurability for critical illness insurance. Some conditions might lead to declination of coverage or exclusions for specific critical illnesses. Question 88. A group short-term health insurance plan issued in North Carolina is designed to provide temporary medical coverage. The policyholder inquires about the renewal process for short-term health plans. How do renewals typically work for short-term health insurance plans? A. Short-term health insurance plans are automatically renewed for as long as the policyholder continues to pay premiums. B. Renewals for short-term health plans are not guaranteed and may be subject to underwriting approval. C. Short-term health plans can only be renewed once. D. All of the above statements, B and C, may apply to renewal of short-term health insurance plans. The correct answer is D. All of the above statements, B and C, may apply to renewal of short-term health insurance plans. Renewals for short-term health insurance plans typically have limitations compared to comprehensive health insurance plans. Renewal not guaranteed. Unlike guaranteed renewals for most employer-sponsored or individual health insurance plans, short-term health plans may not be automatically renewed. The insurance company may decide not to offer renewals or may require underwriting approval to assess your current health status before allowing renewal. Renewal limits. There may be limitations on the number of times a short-term health plan can be renewed. This could be a maximum number of renewals or a maximum total length of coverage, e.g., 1 year. It's important to understand the renewal provisions of your short-term health insurance plan to avoid coverage gaps if you expect to need coverage beyond the initial policy period. Question 89. A health insurance policy issued in North Carolina covers mental health services. The policy defines in-network providers. What does an in-network provider typically represent under a health insurance plan? A. In-network providers are mental health professionals who are not affiliated with the insurance company. B. An in-network provider is a mental health professional who has a contract with the insurance company to provide services at pre-negotiated rates. C. The policyholder needs a referral to see an in-network mental health provider. D. All of the above statements, B and C, may apply to in-network providers in a health insurance plan. The correct answer is D. All of the above statements, B and C, may apply to in-network providers in a health insurance plan. In-network providers are healthcare professionals, including mental health professionals, who have a contract with the insurance company to provide services at pre-negotiated rates. Here's what this means for policyholders. Contracted rates. In-network providers agree to accept the insurance company's predetermined reimbursement rates for covered services. This typically translates to lower out-of-pocket costs for the policyholder compared to seeing an out-of-network provider. Referrals. Some health insurance plans, particularly HMO plans, may require a referral from a primary care physician, PCP, to see an in-network specialist, including mental health professionals. However, this is not always the case, and PPO plans typically offer more flexibility in choosing providers without referrals. Question 90. An individual health insurance policy issued in North Carolina has a high deductible. The policyholder asks about health savings accounts, HSAs. Can HSAs be used to pay for health insurance premiums? A. Health savings accounts, HSAs, can be used to pay for health insurance premiums regardless of the deductible amount. B. HSAs can only be used to pay for qualified medical expenses, not health insurance premiums. C. HSAs are only available with high-deductible health insurance plans, HDHPs. D. All of the above statements, B and C, are true regarding HSAs. The correct answer is D. All of the above statements, B and C, are true regarding HSAs. Health savings accounts, HSAs, are tax-advantaged accounts that can be used to pay for qualified medical expenses. HSAs offer several benefits, but there are eligibility requirements. High-deductible health plan, HDHP. HSAs can only be paired with a qualified high-deductible health insurance plan, HDHP, as defined by the IRS. HDHPs typically have lower monthly premiums but come with higher deductibles that the policyholder must pay out of pocket before the insurance company starts sharing costs. Qualified medical expenses. HSA funds can be used to pay for a wide range of qualified medical expenses not covered by the health insurance plan, including deductibles, copays, coinsurance, and some preventive care services. However, HSAs cannot be used to pay for health insurance premiums. Question 91. A life insurance agent is meeting with a young adult interested in purchasing life insurance. The young adult does not have any dependents but is concerned about potential student loan debt. Would life insurance be a suitable option in this situation? A. Life insurance is not a suitable option unless the young adult has dependents. B. Life insurance can be a way to help cover outstanding debts, such as student loans, in case of death. C. Term life insurance policies are typically affordable and can provide a death benefit to help pay off student loans. D. All of the above statements, B and C, are true regarding life insurance and student loan debt. The correct answer is D. All of the above statements, B and C, are true regarding life insurance and student loan debt. Life insurance isn't just for people with dependents. Here's how it can be relevant in this situation. Debt protection. Life insurance, particularly a term life policy, can provide a death benefit that can be used to pay off outstanding debts, such as student loans, if the policyholder passes away. This can help ease the financial burden on loved ones who might otherwise be responsible for the debt. Term life affordability. Term life insurance policies are typically more affordable, especially for young and healthy individuals. This makes it a potentially suitable option for young adults who want to secure a death benefit to cover student loan debt without a significant financial strain on their current budget. Even without dependents, life insurance can serve a valuable purpose by providing financial security for those who might rely on the policyholder's income. Question 92. A long-term care insurance policy issued in North Carolina covers custodial care services. What do custodial care services typically represent in a long-term care insurance plan? A. Custodial care services provide assistance with daily living activities like bathing, dressing, and eating. B. Long-term care insurance only covers skilled nursing care services provided by medical professionals. C. Custodial care is a different term for palliative care, focused on comfort and pain management. D. All of the above statements, A, B, and C, are true regarding custodial care in long-term care insurance. The correct answer is A. Custodial care services provide assistance with daily living activities like bathing, dressing, and eating. Long-term care insurance can help cover the costs associated with needing assistance with daily living activities due to chronic illness or disability. Here's how different types of care are categorized. Custodial care. This type of care provides assistance with activities of daily living, ADLs, such as bathing, dressing, eating, toileting, and transferring. Custodial care can be provided at home, in assisted living facilities, or in nursing homes. Skilled care. Skilled care services are provided by medical professionals such as nurses and therapists. This type of care is typically needed for more complex medical conditions and rehabilitation needs, and it's often provided in skilled nursing facilities. Question 93. An individual health insurance policy issued in North Carolina has a copayment for urgent care services. The policyholder inquires about the difference between urgent care and emergency room visits. How would you explain the key differences between urgent care and emergency rooms? A. Urgent care centers are only for minor injuries, while emergency rooms handle all medical situations. B. Emergency rooms are for life-threatening situations, while urgent care can handle non-emergency but time-sensitive needs. C. Urgent care centers are typically open extended hours and may offer lower out-of-pocket costs compared to emergency rooms. D. All of the above statements, B and C, are true regarding the differences between urgent care and emergency rooms. The correct answer is D. All of the above statements, B and C, are true regarding the differences between urgent care and emergency rooms. Understanding the difference between urgent care and emergency rooms can help policyholders choose the most appropriate setting for their needs. Emergency rooms. Emergency rooms are equipped and staffed to handle life-threatening situations and serious medical emergencies that require immediate attention. Examples include chest pain, severe bleeding, or head injuries. Urgent care centers. Urgent care centers can treat non-emergency but time-sensitive medical conditions that are not severe enough for an emergency room visit. Examples include ear infections, sprains, or minor allergic reactions. Urgent care centers typically offer extended hours and can often provide faster service compared to emergency rooms, which may have long wait times. Additionally, out-of-pocket costs for urgent care visits might be lower compared to emergency room visits. Question 94. A Medicare supplement insurance policy, Medigap, is designed to supplement Medicare coverage. The policyholder inquires about the out-of-pocket costs associated with Medicare Part B. What does Medicare Part B typically cover? A. Medicare Part B covers all hospital inpatient expenses, including room and board. B. Part B is a supplemental insurance plan offered by private companies to fill gaps in original Medicare. C. Medicare Part B covers outpatient services such as doctor visits, lab tests, and certain preventive care services. D. All of the above statements, A, B, and C, are true regarding Medicare Part B. The correct answer is C. Medicare Part B covers outpatient services such as doctor visits, lab tests, and certain preventive care services. Medicare Part B is a component of Original Medicare that helps cover the costs of certain outpatient medical services. Here's a breakdown of Medicare coverage. Medicare Part A covers inpatient hospital stays, skilled nursing facility care, hospice care, and home health care services. Medicare Part B covers outpatient services such as doctor visits, specialist consultations, lab tests, X-rays, some preventive care services, and durable medical equipment. Medigap supplement insurance plans can help fill gaps in original Medicare coverage, such as deductibles, copays, and coinsurance for Part B services. Part B does not cover all outpatient expenses, and there can be out-of-pocket costs associated with this coverage. Question 97. A health insurance policy issued in North Carolina excludes coverage for cosmetic surgery. The policyholder inquires about procedures that may be considered cosmetic surgery. How would you define cosmetic surgery under a health insurance plan? A. Cosmetic surgery is any surgical procedure performed on the face. B. Cosmetic surgery refers to surgical procedures that are performed to improve appearance, not for medical necessity. C. Reconstructive surgery, even if it improves appearance, is typically covered under most health insurance plans. D. All of the above statements, B and C, are true regarding cosmetic surgery and health insurance coverage. The correct answer is D. All of the above statements, B and C, are true regarding cosmetic surgery and health insurance coverage. Cosmetic surgery is generally excluded from coverage under most health insurance plans. Here's the key distinction. Cosmetic surgery. Procedures primarily intended to improve appearance, such as breast augmentation, liposuction, or rhinoplasty, nose job, are typically considered cosmetic surgery and not covered by health insurance. Reconstructive surgery. Procedures performed to correct a deformity or address a medical condition, even if they have some cosmetic benefit, may be covered under health insurance. Examples include breast reconstruction after a mastectomy or facial reconstruction after an accident. Question 96. An agent is explaining Medicare Part D prescription drug coverage to a client. The client asks if there are any limitations on the number of medications covered by a Medicare Part D plan. Can Medicare Part D plans limit the number of covered medications? A. Medicare Part D plans cannot limit the number of medications they cover by law. B. Part D plans can limit the number of medications covered, but they must also offer a formulary with a variety of medications in each therapeutic class. C. Medicare Part D plans typically have a formulary that lists covered medications, but there may not be medications for every condition. D. All of the above statements, B and C, are true regarding Medicare Part D and covered medications. The correct answer is D. All of the above statements, B and C, are true regarding Medicare Part D and covered medications. Medicare Part D prescription drug plans have a formulary that lists the medications covered by the plan. Here's what to consider. Formulary. Part D plans are not required to cover every single medication. They have a formulary that includes covered medications categorized by therapeutic class, e.g., drugs for blood pressure, diabetes, etc. The formulary may change from year to year. Coverage limitations. Part D plans can apply different coverage tiers to medications on the formulary. This might involve higher copays for certain medications or requiring you to try a lower-cost medication before covering a more expensive one, step therapy. Exclusions. Not all medications are covered under Part D. Some plans may exclude specific drugs altogether. Question 97. A group life insurance policy issued in North Carolina covers accidental death. The policy defines the term accidental death. What does accidental death typically mean under a life insurance policy? A. Accidental death only covers deaths caused by car accidents. B. An accidental death is any unexpected death not caused by natural causes or illness. C. Accidental death benefits are typically double the face amount of the life insurance policy. D. Definitions of accidental death can vary by policy, but they often exclude certain circumstances like suicide or self-inflicted injuries. The correct answer is D. Definitions of accidental death can vary by policy, but they often exclude certain circumstances like suicide or self-inflicted injuries. Accidental death benefit riders can be added to some life insurance policies to provide an additional payout if the death is accidental. However, the definition of accidental death can vary by policy. Accidental death generally refers to an unexpected death not caused by natural causes or illness. It often excludes deaths due to suicide, self-inflicted injuries, or high-risk activities excluded by the policy language. Policy-specific. It's important to review the specific policy wording regarding the definition of accidental death and any exclusions that might apply. Additional information. Accidental death benefit riders typically come with an additional premium cost. Question 98. A health insurance policy issued in North Carolina has a deductible. The policyholder wants to understand how the deductible applies. Can you explain how a deductible typically works in a health insurance plan? A. The deductible is the annual out-of-pocket maximum that the policyholder must pay for covered services. B. The deductible is a fixed dollar amount that the policyholder must pay before the insurance company starts sharing costs for covered services. C. Once the deductible is met, the policyholder is responsible for 100% of covered expenses until they reach the out-of-pocket maximum. D. All of the above statements, A, B, and C, are false. The correct answer is B. The deductible is a fixed dollar amount that the policyholder must pay before the insurance company starts sharing costs for covered services. The deductible is a key feature in many health insurance plans. Here's how it works. Fixed dollar amount. The deductible is a specific dollar amount that the policyholder must pay out of pocket for covered medical expenses before the insurance company starts sharing costs according to the plan provisions, coinsurance or copay. Meeting the deductible. Once the policyholder accumulates enough covered expenses to reach the deductible amount, the insurance company will typically begin to pay its share according to the coinsurance percentage or copay amount outlined in the plan. Question 99. An agent is meeting with a client interested in critical illness insurance. The client inquires about the benefits offered by critical illness insurance. How would you describe the benefits typically provided by critical illness insurance? A. Critical illness insurance pays a lump sum benefit if the policyholder is diagnosed with a covered critical illness, such as cancer or heart attack. B. Critical illness insurance can help cover the costs of treatment for critical illnesses. C. Critical illness benefits can be used for various purposes, including income replacement, medical bills, or long-term care needs. D. All of the above statements, A, B, and C, are true regarding critical illness insurance benefits. The correct answer is D. All of the above statements, A, B, and C, are true regarding critical illness insurance benefits. Critical illness insurance is designed to provide financial protection in case of a serious medical condition. Here are some key benefits. Lump sum benefit. Upon diagnosis of a covered critical illness defined by the policy, the insurance company pays a lump sum benefit directly to the policyholder. Flexibility in use of funds. The policyholder has flexibility in how to use the benefit payout. It can be used to cover medical bills, replace lost income during treatment, or for other financial needs arising from the illness. Not a replacement for health insurance. Critical illness insurance is not a substitute for health insurance. It does not typically cover the costs of treatment itself, but rather provides a financial safety net to help manage the financial burden associated with a critical illness. Question 100. A life insurance policy issued in North Carolina has a grace period for premium payments. What does the grace period typically represent in a life insurance policy? A. The grace period is the time frame after a premium is due before the policy lapses. B. During the grace period, the policy remains active even if the premium is not paid. C. The grace period allows the policyholder to pay the missed premium without any penalties. D. All of the above statements, A, B, and C, are true regarding the grace period in a life insurance policy. The correct answer is A. The grace period is the time frame after a premium is due before the policy lapses. The grace period is a temporary window of time offered by the insurance company after a premium due date has passed. Here's what to consider. Policy lapse prevention. The grace period provides a buffer zone to prevent immediate policy lapse for non-payment. It allows time for the policyholder to make the premium payment and keep the policy in force. Length of grace period. The grace period length can vary by policy, typically ranging from 30 to 60 days. Not guaranteed coverage. While the policy remains active during the grace period, coverage may be suspended if the premium is not paid by the end of the grace period. The policy could lapse, and reinstatement might require additional underwriting or incurring penalties. Question 101. A health insurance policy issued in North Carolina covers preventive care services. The policyholder inquires about the difference between preventive and diagnostic care services. How would you explain the key differences between preventive and diagnostic care? A. Preventive care focuses on preventing illness, while diagnostic care identifies existing medical conditions. B. Preventive care services are typically covered by health insurance plans, while diagnostic tests may require prior authorization. C. Both preventive and diagnostic care services can involve screenings and checkups. D. All of the above statements, A, B, and C, are true regarding preventive and diagnostic care. The correct answer is D. All of the above statements, A, B, and C, are true regarding preventive and diagnostic care. Understanding the distinction between preventive and diagnostic care is helpful for policyholders. Preventive care. Preventive care services are focused on preventing illness or identifying potential health problems early on. Examples include vaccinations, screenings, like mammograms or colonoscopies, and wellness visits. Preventive care services are typically covered by health insurance plans with little to no out-of-pocket costs for the policyholder. Diagnostic care. Diagnostic care services are performed to diagnose a suspected medical condition or to determine the cause of symptoms. This might involve tests like X-rays, blood tests, or biopsies. Diagnostic tests may require prior authorization from the insurance company depending on the plan design. Question 102. An individual health insurance policy issued in North Carolina has a coinsurance provision. The policy defines coinsurance. What does coinsurance typically represent in a health insurance plan? A. Coinsurance is a fixed dollar amount that the policyholder must pay for covered services. B. After the deductible is met, coinsurance is the percentage of covered charges that the policyholder is responsible for paying. C. Coinsurance applies to all covered services under the health insurance plan. D. All of the above statements, A, B, and C, are false regarding coinsurance. The correct answer is B. After the deductible is met, coinsurance is the percentage of covered charges that the policyholder is responsible for paying. Coinsurance is a cost-sharing feature found in many health insurance plans. Here's how it works. Sharing costs. After the policyholder meets the deductible, coinsurance applies. It's a percentage of the approved covered charges that the policyholder is responsible for paying. For example, a plan with 80/20ths coinsurance means the insurance company pays 80% of the approved charges after the deductible, and the policyholder is responsible for the remaining 20%, coinsurance. Not a flat fee. Coinsurance is not a fixed dollar amount. It's a percentage that applies to the total allowable charges for covered services. Question 103. Ms. Lee is a resident of North Carolina and is considering purchasing a long-term care insurance policy. She is concerned about the potential for the cost of her premiums to increase in the future. Under North Carolina law, what guarantee does Ms. Lee have regarding premium increases for long-term care insurance policies? A. Premiums cannot increase under any circumstances. B. Premiums can only increase with prior written notice to the policyholder. C. Premiums can only increase based on a community rating basis. D. Premiums can increase based on the policyholder's age and health status. The correct answer is C. Premiums can only increase based on a community rating basis. North Carolina mandates community rating for long-term care insurance policies. This means that premiums for the policy can only be adjusted based on factors that apply to the entire group of policyholders in the same rating category, such as age, gender, and geographic location. Premiums cannot be increased based on an individual's health status or claims history. This law helps protect policyholders from unexpected premium hikes and ensures that premiums remain affordable over the long term. You can find more details about this regulation in the North Carolina Department of Insurance Consumer Guides for Long-Term Care Insurance. Question 104. Mr. Rodriguez is a life insurance agent licensed in North Carolina. He is contacted by a potential client who lives in South Carolina. Can Mr. Rodriguez sell life insurance to this client? A. Yes. Mr. Rodriguez can sell life insurance to the client as long as he is properly licensed in North Carolina. B. Yes. Mr. Rodriguez can sell life insurance to the client if he obtains a non-resident license in South Carolina. C. No. Mr. Rodriguez cannot sell life insurance to the client because he is not licensed in South Carolina. D. No. Mr. Rodriguez cannot sell life insurance to the client because North Carolina prohibits selling insurance to out-of-state residents. The correct answer is C. No. Mr. Rodriguez cannot sell life insurance to the client because he is not licensed in South Carolina. Life insurance agents must be licensed in the state where the insured resides. Therefore, Mr. Rodriguez cannot sell life insurance to a client in South Carolina without obtaining a proper license in that state. This regulation prevents unauthorized practice of insurance and ensures that agents selling insurance products are knowledgeable about the specific laws and regulations of the state. Question 105. An individual health insurance policy in North Carolina covers a specific network of doctors and hospitals. This type of plan is most likely classified as A. Indemnity plan. B. Preferred Provider Organization, PPO. C. Health Maintenance Organization, HMO. D. Medicare Supplement. The correct answer is C. Health Maintenance Organization, HMO. HMOs, health maintenance organizations, are a type of managed care plan that has a network of contracted providers. Policyholders are typically required to choose a primary care physician within the network for most covered services. HMOs emphasize preventive care and may offer lower premiums compared to other plan types like PPOs, preferred provider organizations, which allow for more flexibility in choosing providers but may come with higher out-of-network costs. North Carolina mandates that certain consumer protection provisions are included in HMO policies, so it's important for agents to be familiar with these regulations as well. You can find more details about HMOs and other health plan types in the NC Department of Insurance Consumer Guides. Question 106. Ms. Hernandez is a resident of North Carolina and is applying for an individual health insurance policy. She has a pre-existing medical condition. North Carolina has a guaranteed issue law for health insurance. What does this law mean for Ms. Hernandez? A. She cannot be denied coverage based on her pre-existing condition. B. She can be denied coverage, but the premium rate cannot be increased. C. She can be offered a policy with limited benefits for her pre-existing condition. D. She will need to complete a waiting period before coverage for her pre-existing condition takes effect. The correct answer is A. She cannot be denied coverage based on her pre-existing condition. North Carolina's guaranteed issue law prohibits health insurance companies from denying coverage to individuals based on pre-existing medical conditions. This law ensures that people with pre-existing conditions can access affordable health insurance. However, the law may allow insurers to charge higher premiums to individuals with certain health conditions, but the rate increase must be justified and applied on a community rating basis. Question 107. Mr. Khan is a life insurance agent selling a term life insurance policy in North Carolina. The policy has a level premium payment schedule. What does this mean for Mr. Khan's client? A. The premium amount will increase every year. B. The premium amount will decrease every year. C. The premium amount will remain constant throughout the policy term. D. The premium amount will be determined based on the client's age and health at the time of renewal. The correct answer is C. The premium amount will remain constant throughout the policy term. Term life insurance policies with a level premium payment schedule guarantee that the premium amount will remain the same throughout the entire policy term. This provides predictability for the policyholder in terms of budgeting for the cost of coverage. However, unlike whole life insurance policies, term life policies do not accumulate cash value and expire at the end of the term if not renewed. Mr. Khan should ensure his client understands these key features of term life insurance. Question 108. An individual health insurance policy in North Carolina offers coverage for prescription drugs. According to North Carolina regulations, what is most likely required for coverage of a specific prescription drug? A. The prescription must be written by a licensed physician within the policy's network. B. The prescription must be for a medication included on a formulary list approved by the insurer. C. The prescription must be filled at a pharmacy in network with the insurance company. D. All of the above may be required for coverage of a specific prescription drug. The correct answer is D. All of the above may be required for coverage of a specific prescription drug. Many individual health insurance plans in North Carolina utilize formularies, which are lists of medications covered by the plan. These lists may categorize medications by tier, with lower tiers typically having lower copays or coinsurance requirements. Additionally, some plans may require prescriptions to be written by in-network providers and filled at in-network pharmacies to qualify for the maximum coverage benefit. It's important for Mr. Khan to explain these potential limitations in coverage when discussing prescription drug benefits with clients. Question 109. Ms. Garcia is a resident of North Carolina and is considering purchasing a Medicare supplement policy, Medigap. She is concerned about the out-of-pocket costs associated with original Medicare. How can a Medicare supplement policy help Ms. Garcia address this concern? A. It replaces original Medicare entirely and provides comprehensive health coverage. B. It acts as a secondary insurance plan that pays for some of the out-of-pocket costs associated with original Medicare, such as deductibles and copayments. C. It expands eligibility for benefits under original Medicare and covers services not included in Part A or Part B. D. It lowers Ms. Garcia's monthly Medicare Part B premium payments. The correct answer is B. It acts as a secondary insurance plan that pays for some of the out-of-pocket costs associated with original Medicare, such as deductibles and copayments. Medicare Supplement Insurance, Medigap, plans are designed to help beneficiaries with original Medicare, Parts A and B, by covering some of the out-of-pocket expenses, such as deductibles, copayments, and coinsurance. These plans do not replace original Medicare but work in conjunction with it. By choosing a standardized Medigap plan, Plan A, B, D, etc., in North Carolina, Ms. Garcia will have predictable coverage regardless of the insurance company she selects. It's important for agents to be familiar with the different Medigap plan options and limitations to ensure they recommend a plan that best meets Ms. Garcia's needs. Question 110. Mr. Patel is a life insurance agent in North Carolina who is explaining the concept of contestability to a client. What is the most accurate explanation of the contestability period in a life insurance policy? A. The period during which the insurance company can contest the policyholder's insurability based on misrepresentations on the application. B. The period during which the beneficiary cannot file a claim on the policy. C. The guaranteed period after which the policy cannot be canceled by the insurance company. D. The grace period for making premium payments. The correct answer is A. The period during which the insurance company can contest the policyholder's insurability based on misrepresentations on the application. The contestability period is a clause in most life insurance policies that allows the insurance company to challenge the validity of the policy based on material misrepresentations made by the applicant on the application. This period typically lasts for 2 years from the date of policy issuance in North Carolina. If the insurance company discovers a material misrepresentation during this time, they may be able to rescind the policy and deny payment of the death benefit. Mr. Patel should emphasize the importance of honesty and accuracy when completing the application to avoid any potential issues with the policy down the road. Question 111. An individual health insurance policy in North Carolina covers mental health services. North Carolina has a mental health parity law. What does this law require health insurance companies to do? A. Cover mental health services at the same level of benefits as physical health services. B. Offer a separate mental health insurance policy to individuals seeking such coverage. C. Provide a network of qualified mental health professionals for in-network coverage. D. Require policyholders to complete a mandatory waiting period before receiving mental health services. The correct answer is A. Cover mental health services at the same level of benefits as physical health services. Mental health parity laws aim to prevent discrimination in health insurance coverage for mental health conditions. North Carolina's mental health parity law mandates that health insurance companies provide coverage for mental health services at the same level of benefits, e.g., deductibles, copayments, coinsurance, as they do for physical health services. This helps ensure that individuals with mental health conditions have access to affordable treatment. It's important for agents to be aware of these parity laws and to be able to explain how they apply to different health insurance plans. Question 112. Ms. Johnson is a resident of North Carolina and is considering purchasing a long-term care insurance policy. She is concerned about the possibility of the policy being canceled by the insurance company. North Carolina has regulations regarding guaranteed renewal for long-term care insurance. What does guaranteed renewal offer to Ms. Johnson? A. The right to cancel the policy at any time without penalty. B. The right to renew the policy at the same premium rate regardless of her health status. C. The right to convert the policy to a different type of insurance product. D. The right to reinstatement of the policy if it lapses due to non-payment of premiums. The correct answer is B. The right to renew the policy at the same premium rate regardless of her health status. Guaranteed renewal is a provision in most long-term care insurance policies in North Carolina that allows the policyholder to renew the policy for each renewal period, as long as premiums are paid on time. This protects Ms. Johnson from the insurance company canceling the policy due to her age or health condition. However, the premium rate may increase based on factors allowed by the policy and North Carolina regulations, but it cannot be based on her individual health status. Question 113. Mr. Lee is a life insurance agent in North Carolina and is contacted by a potential client who wants to purchase a variable universal life insurance policy, VUL. What is one of the key features of a VUL policy that Mr. Lee should explain to the client? A. The death benefit is guaranteed to remain level throughout the policy term. B. The cash value grows at a fixed interest rate. C. The cash value has the potential to grow based on the performance of underlying investments. D. The premiums are guaranteed to remain level throughout the policy term. The correct answer is C. The cash value has the potential to grow based on the performance of underlying investments. Variable Universal Life, VUL, insurance is a type of life insurance that combines death benefit protection with a cash value component that has the potential to grow based on the investment choices made by the policyholder. Mr. Lee should explain the risks and rewards associated with VUL policies. The cash value may grow or decrease depending on the performance of the chosen investment options. Unlike traditional universal life policies, VULs do not offer a guaranteed interest rate on the cash value. Question 114. An individual health insurance policy in North Carolina excludes coverage for cosmetic surgery. North Carolina has a mandated coverage provision for certain health services. Which of the following is most likely not a mandated service under North Carolina's health insurance regulations? A. Mammography screenings. B. Emergency room services. C. Treatment for substance use disorder. D. Cosmetic surgery. The correct answer is D. Cosmetic surgery. North Carolina mandates that certain health services are covered under most individual and small group health insurance plans. These mandated services typically include preventive care screenings, emergency room services, and treatment for mental health and substance use disorders. Cosmetic surgery is generally excluded from health insurance coverage because it is considered an elective procedure that is not medically necessary. Mr. Lee should be familiar with the mandated coverage provisions in North Carolina to ensure he is accurately representing the benefits of different health insurance plans. Question 115. Ms. Davis is a resident of North Carolina and is considering purchasing a disability income insurance policy. What is one of the key factors Ms. Davis should consider when choosing a disability income insurance policy? A. The face amount of the policy, which determines the total death benefit paid. B. The elimination period, which is the waiting time before benefits begin after a disability. C. The benefit period, which determines how long Ms. Davis will receive benefits if disabled. D. The cash value accumulation rate, which is important for building wealth within the policy. The correct answer is B. The elimination period, which is the waiting time before benefits begin after a disability. Disability income insurance policies provide financial protection in case Ms. Davis becomes disabled and unable to work. One crucial factor to consider is the elimination period. This is the time frame between the onset of a disability and when the policy starts paying benefits. A longer elimination period typically results in a lower premium, but Ms. Davis will have to wait longer to receive income if she becomes disabled. It's important for Mr. Lee to discuss Ms. Davis's financial situation and needs to help her choose an elimination period that is suitable for her. Question 116. Mr. Garcia is a life insurance agent in North Carolina and is explaining the concept of replacement of life insurance to a client. What does the North Carolina replacement of life insurance regulation require? A. The agent must obtain written consent from the existing policyholder before replacing a life insurance policy. B. The agent must prove the new policy offers a significant financial benefit to the client. C. The agent cannot replace a life insurance policy within the first 2 years of its issuance. D. All of the above are requirements of the North Carolina replacement of life insurance regulation. The correct answer is D. All of the above are requirements of the North Carolina replacement of life insurance regulation. North Carolina has regulations in place to protect consumers from inappropriate replacement of life insurance policies. These regulations require agents to obtain written consent from the existing policyholder before replacing a policy. Additionally, agents must demonstrate that the new policy offers a significant financial benefit to the client, such as lower premiums or increased coverage. Finally, replacing a life insurance policy within the first 2 years of its issuance is generally discouraged due to potential surrender charges and lost benefits. Mr. Garcia should be familiar with these regulations and ensure he complies with them when discussing replacement of life insurance with clients. Question 117. An individual health insurance policy in North Carolina offers coverage for hospitalization. According to North Carolina regulations, what is most likely required for coverage of an inpatient hospital stay? A. The admission must be pre-authorized by the insurance company. B. The hospitalization must be for a minimum number of consecutive nights. C. The attending physician must be in network with the insurance company. D. All of the above may be required for coverage of an inpatient hospital stay. The correct answer is D. All of the above may be required for coverage of an inpatient hospital stay. Health insurance coverage for hospitalization can vary depending on the specific plan design. Some plans may require pre-authorization from the insurance company before admitting a patient for an elective procedure. Additionally, some plans may have minimum stay requirements for inpatient hospitalization to be considered medically necessary. In-network providers typically offer the most significant coverage benefit, so out-of-network hospital stays may come with higher costs for the policyholder. It's important for agents to explain these potential limitations in coverage when discussing hospitalization benefits with clients. Question 118. Ms. Hernandez is a resident of North Carolina and is considering purchasing a Medicare Advantage, Part C, plan. What is one of the key differences between a Medicare Advantage plan and Original Medicare, Parts A and B? A. Medicare Advantage plans are offered directly by the federal government. B. Medicare Advantage plans typically have no monthly premiums, while Original Medicare does. C. Original Medicare covers a wider range of services compared to Medicare Advantage plans. D. Medicare Advantage plans offer more flexibility in choosing healthcare providers. The correct answer is D. Medicare Advantage plans offer more flexibility in choosing healthcare providers. Original Medicare, Parts A and B, is a fee-for-service program that allows beneficiaries to choose any doctor or hospital that accepts Medicare. In contrast, Medicare Advantage plans are offered by private insurance companies that contract with Medicare. These plans typically have a network of approved providers, although some plans may offer out-of-network coverage with higher cost-sharing requirements. Therefore, Medicare Advantage plans may offer more flexibility in terms of plan design, including features like prescription drug coverage and potential for lower out-of-pocket costs, but they may also restrict choice of providers compared to Original Medicare. Question 119. Mr. Patel is a life insurance agent in North Carolina and is contacted by a potential client who wants to purchase a critical illness insurance policy. What is one of the benefits typically offered by a critical illness insurance policy? A. It pays a death benefit to the beneficiary upon the policyholder's death. B. It reimburses the policyholder for medical expenses incurred due to a covered critical illness. C. It provides long-term care services for the policyholder if diagnosed with a critical illness. D. It waives the premiums on other insurance policies if the policyholder is diagnosed with a critical illness. The correct answer is A. It pays a death benefit to the beneficiary upon the policyholder's death. Critical illness insurance is a type of supplemental insurance that provides a lump sum cash benefit if the policyholder is diagnosed with a covered critical illness, such as cancer, heart attack, or stroke. This benefit can be used for various purposes, such as covering out-of-pocket medical expenses, replacing lost income, or debt repayment. It's important for Mr. Patel to clarify that critical illness insurance does not typically reimburse medical expenses directly or provide long-term care services. While some critical illness policies may offer a premium waiver rider if diagnosed with a critical illness, this is not a guaranteed feature and should be confirmed with the specific policy details. Question 120. An individual health insurance policy in North Carolina covers preventive care services. North Carolina has a mandate for coverage of preventive services for certain conditions. Which of the following is most likely not a preventive service mandated for coverage under North Carolina's health insurance regulations? A. Annual mammograms for women over the age of 40. B. Childhood immunizations according to the CDC recommended Schedule. C. Treatment for a diagnosed case of high blood pressure. D. Colorectal cancer screenings for adults starting at a certain age. The correct answer is C. Treatment for a diagnosed case of high blood pressure. North Carolina mandates that certain preventive care services are covered under most individual and small group health insurance plans. These mandated services typically focus on early detection and prevention of chronic diseases. Examples include annual mammograms, childhood immunizations, and colorectal cancer screenings. Treatment for a diagnosed medical condition, such as high blood pressure, is typically considered a covered benefit under most health insurance plans, but it's not specifically mandated as a preventive service. It's important for agents to be familiar with the distinction between preventive and treatment services and how they are covered under different health insurance plans.